Hi, and thank you for joining us for our second uranium conference of the year. The uranium sector continues to gather strength, with uranium being up over 50% in the year, and this is being driven by a sense of urgency associated with global warming and also carbon neutrality. Policymakers are waking up to the fact that carbon neutrality can only be achieved with supplementing current energy portfolios with nuclear energy. And who better to speak on what's happening within the nuclear energy sector than Sama Bilbao, the Director General of the World Nuclear Association. The WNA is the international organization which represents the global nuclear industry, and Sama is going to provide an overview of the WNA, insights on COP26, and the taxonomy regulation and what it means for the nuclear industry in the European Union. Our first company presenter is Askar Batyrbayev, the Chief Commercial Officer of Kazatomprom. Kazatomprom is the world's largest uranium producer, and Askar is going to provide us with an overview of Kazatomprom's operations, its involvement in creating a physical trust investment fund, and recent contracts signed with Chinese utilities. Then we will hear from Purdy, CEO of Paladin Energy. Paladin is restarting the past uranium producer called Langer Heinrich, which is based in Namibia. Ian will give us an update on the restart, the upside potential at Langer Heinrich, and also an overview of its various exploration properties. Then we will hear from Mark Chalmers, CEO of Energy Fuels. Energy Fuels is a US-based critical minerals producer, producing both uranium and rare earth carbonate. Energy Fuels has 3 uranium mines, which are currently on standby, and Energy Fuels also owns the White Mesa Mill, which is the only uranium processing facility in the US. Presenting next is Roger Lemaitre of UEX Corp. UEX holds an extensive portfolio of 31 assets in the Athabasca Basin, and we will focus on 4 of the most significant assets. UEX recently completed a small summer drill program and is preparing for a winter program, and we will get an update on those drill programs. Then we will hear from John Ciampaglia, CEO of Sprott Asset Management. John and his team oversee the management of the Sprott Uranium Physical Trust product, and John is going to provide an update on how much uranium the fund has acquired. Sprott recently acquired the North Shore Uranium ETF, and John will explain the reasoning behind that acquisition. Grant Isaac is the CFO of Cameco, and Cameco is the world's second largest uranium producer. Cameco has some of the highest grade uranium mines in the world, including Cigar Lake and McArthur River, which are located in the Athabasca Basin. And Grant will provide an update on those mines as well as his thoughts on where the uranium price is going. The conference ends with our second keynote speaker, Guy Keller. Guy is a portfolio manager and commodities analyst at Tribeca Investment Partners, an asset manager based in Sydney, Australia, and manages over $3 billion in assets, a portion of which is allocated toward uranium stocks. Guy is going to explain why he and his team are bullish on uranium and where they see the uranium price going. If you have any questions for any of our presenting companies, send us an email to info@bloorstreetcapital.com, or you can write your question in the open chat on the right-hand side of your screen. Don't forget to subscribe to our channel, Bloor Street Capital, and also hit that notification button to be kept up to date on future events. I hope you enjoy the conference. Hi, Sama, and thank you very much for joining us today.
Thank you for inviting me, James. It is my pleasure.
I want to provide an overview on where I want to take our discussion over the next few minutes, and I want to touch on 4 elements, beginning with an overview of the World Nuclear Association, COP26, taxonomy regulation as it pertains to the EU, and I want to conclude with your thoughts on nuclear energy and if it's different this time. Sama, let's begin with a brief overview of the World Nuclear Association and its mandate.
Okay, so World Nuclear Association is the international organization that represents the global nuclear industry. So we have we have exactly 185 members right now from 44 countries in all continents. So that's quite significant. But what I think is even more significant is these members represent the entire nuclear fuel cycle. So we have members from the uranium mining industry, conversion, enrichment, fuel fabrication. We also have, obviously, the utilities that are producing electricity with nuclear energy, but also all the nuclear vendors, the nuclear designers, the nuclear suppliers. And then if you look at the back end of the fuel cycle, we also include some of the organizations that are dealing with the used fuel management, radioactive waste management, the commissioning. So essentially the entire fuel cycle. And also we have among our members all this other ecosystem of essential organizations in support of the nuclear sector. So we have nuclear law, we have nuclear finance, we have insurance, we have transportation, and we have a myriad of different engineering companies and support companies that support essentially the global nuclear industry. So we have the among our mandate is, of course, to create a positive predisposition among global stakeholders when it comes to nuclear energy, to provide substantive and assertive information about nuclear, and of course to be a thought leader within all these discussions that are taking place nowadays in the energy debate.
The WNA publishes a wealth of information, including the Nuclear Fuel Report, which is essentially the Bible for the uranium supply and demand. I want to get a sense of the growth in the industry and how it pertains to demand for uranium. Can you just provide us like a brief overview of what's happening within the nuclear energy sector and the growth that we're seeing?
Yes, definitely. So maybe I will start by giving you a vision of what is the current role of nuclear energy in the overall electricity supply, and then maybe we can go more in depth onto what this means as far as uranium supply and demand. So just so you know, at the end of 2020, there were 441 reactors operating worldwide. And they have a combined capacity of over 390 gigawatts electric. So this is electrical capacity. So they actually produce over, 2,500 terawatts hour of electricity at a global level in 2020. And this is more or less 10% of the global electricity supply. So it is a significant chunk, and this is at a global level. I think you probably know that nuclear energy is today the largest source of low carbon electricity in developed countries, and it is the second source of low carbon electricity at a global level, only behind hydropower. So that is as far as the operation. In addition to that, we had over 50 reactors that were under construction all over the world. So as you see, there was, it is a significant contribution to the electricity supply at a global level. So maybe to put in perspective, whether this is too much, too little, how is it growing? So I will tell you that the nuclear capacity at a global level has remained more or less constant for the last 3 or so years. So what this means that even though every year we start up new reactors, also every year there is a few reactors that are permanently shut down. So then even though the global capacity is more or less constant, the actual electricity that is being generated has been increasing year after year. So that tells you that even though we have the same number of reactors, we are operating them much more effectively. So, and the only year where this trend kind of broke down a little bit was, of course, 2020, because as you know, we all faced this global pandemic. So the overall global demand for electricity went down about 5%, and then this means that overall the demand for nuclear electricity also came down a little bit. So what happened is that nuclear reactors actually in 2020 were very flexible, and what they were doing, they were compensating for the variability of the renewable energy sources. So that's more or less where we are. And one thing that I think is important to highlight is the majority of the reactors that permanently shut down in the last few years, they have done that not because of technical limitations or because of safety issues, that they have been primarily, number one, because of political reasons, and number two, because of the failure of markets to adequately recognize the value of round-the-clock, low-carbon, clean nuclear electricity. So that's more or less the status.
And China has been getting very involved in nuclear energy. It's been well publicized that they want to build 150 reactors over the next 15 years. Can you put that into perspective for us? Like, is 150 reactors a lot?
Oh my gosh, yes, it is a lot. Now, I think it's, China has been incredibly active in the development of new nuclear for the last, 20 plus years. I mean, like, for example, in the last 10 years, China has started 40 new reactors, and those 40 reactors would be sufficient to provide 100% of the electricity here, for example, in the UK, where I live right now. So that tells you the UK could have been 100% decarbonized had they invested on those reactors for the last 10 years. So that tells you the magnitude. But yeah, clearly this goal that China has of building 150 new reactors in the next 15 years, it is a high goal. But you know, they kind of need to. If they really want to continue to elevate the standard of living of the average Chinese at the same time as they decarbonize, they really need to. So, and frankly, it is a tall order, but they have showed us that they can do it. They've been incredibly effective building nuclear power plants on time and on budget for the last, as I said, 20 years. So it is challenging. I'm not saying it's going to be easy, but I think that they are in a good way to do it.
Very good. I want to move on now and talk about COP26. Now, don't get angry with me, Sama, but I have to confess I've never heard of this conference before until this year. And though it's been going on for decades, and it seems to have garnered a lot of media attention this year. Can you just give us a little bit of background on this conference and tell us why we've heard so much about it this year?
Yes. Don't feel bad, because I think that you may be not the only person that has not really heard about COP. So now, the number 26 means that this group of countries have met 26 times. I mean, this was the 26th time that they met to talk about what the world can do in order to address the issue of global warming and climate change. So maybe I'd like to maybe highlight a couple of maybe to give your audience a little bit of background. So maybe some of you remember that in the year 2015, there was what was called COP 2021, in which once again all the countries in the world actually met, and they all signed what was called the Paris Agreement. And this was an agreement in which every country in the world agreed to work together to do what they could at their country level in order to limit the global carbon emissions in a way that the global temperature increase would be below 2 degrees. So that's what they did in 2015. And then part of that agreement is that they were going to meet every 5 years, and every 5 years they were going to actually assess very carefully where they were to actually meet these goals. So this is the reason why COP26 was a very, very big deal, because this was the first time that all the countries in the world met, and they actually came with their calculators, and they came with their commitments, and they were trying to see how were we doing in order to actually meet this commitment or these goals of reaching these 2 degrees of maximum 2 degrees heating. So that's what we did in Glasgow.
Let's move on now to taxonomy regulation in the European Union. We're hearing a lot about this lately. Can you just provide us with an overview of taxonomy as it pertains to the EU and what it means to the nuclear energy sector?
Okay, sure. Yes, the taxonomy essentially is an effort that the European Union has put together in order to make it easier for investors to invest, obviously, in sustainable activities, in sustainable companies. So basically, what they want to do is to ease out the flow of capital towards clean energy and towards sustainable economic activities. And I think this is important for your audience to realize that this taxonomy is one of many. So right now there is lots of efforts at a global level, not only in Europe, all over the world, trying to figure out what is the best way to incentivize investors to put their money in clean technologies, in low carbon energy, in clean infrastructure. But okay, back to the European Union. So the European Union has been working on this for the last couple of years, and again, this covers all economic activities, not only energy. So it looks at agriculture, it looks at manufacturing, it looks at transportation. So it is a very, very big package. And so far, until very recently, the European Union, so nuclear energy was not included in the taxonomy because they weren't, they said that they didn't have enough information to assess whether nuclear energy could be considered sustainable compared to other energy sources. So the good news is that it was earlier this year, it was about, I think it was in June, the European Joint Research Center actually produced a report that provided in a lot of detail the information that actually was in March. The Joint Research Center provided a report that explained how nuclear energy is exactly as sustainable as any other low carbon energy source that is already included in the taxonomy. So what is happening now is that the European Commission is going to put together what they call a complementary delegated act, essentially a complementary set of rules and criteria that are going to consider how can nuclear energy be included within the taxonomy, what are the rules, what are the criteria that need to be met in order to consider nuclear as one of the energy sources that are considered as sustainable in the taxonomy. So this is where we are right now. As far as timelines, we don't know exactly when this is going to happen. We have been told that it's going to happen very soon. We expect this complementary delegated act to be published. I mean, the draft complementary delegated act sometime before the end of the year. So I don't know if it's going to be tomorrow or in 2 weeks, but somewhere before the end of the year. And we are just, trying to watch what are the criteria that the Commission is going to use to include nuclear in this taxonomy.
But bottom line is, it would be, once it passes, it's going to be very positive for the sector and very positive for uranium.
Correct. I mean, so the idea is that, so if nuclear energy is one of the economic activities that are considered sustainable, basically many things are going to happen. Number one, investors are going to find that it's going to be easier for them to invest in different aspects of the entire nuclear supply chain. It's not only nuclear energy. As you said, it could be uranium mining, it could be, I don't know, fuel fabrication, it could be some other pieces of the supply chain. But just as importantly, the taxonomy covers all economic activities. So imagine that you are a factory that produces aluminum, for example. So you need to, the way in which you power your factory is going to be important. So if you are using nuclear energy to power your aluminum production factory, it is actually going to be better. So you are going to be considered sustainable aluminum, as opposed to if you were to use, say, natural gas or coal or some other energy source that would not be considered sustainable. So it's not only good for nuclear energy, but it's actually going to contribute to truly decarbonize the overall economy in Europe. And actually, I will tell you that this is going to be imperative for countries, particularly in the eastern side of Europe. I think you've heard Poland, Czech Republic, Slovakia, Slovenia, Romania, Bulgaria, etc. All those countries, they really currently rely on nuclear energy, but as they are growing, they really are looking to continue expanding their use of nuclear. So they really are very much depending on making sure that nuclear is among the energy sources that are considered sustainable.
Salma, as we wrap up, the case for nuclear energy and by extension uranium sounds very bullish. In addition to policymakers, the world's largest corporations are also adopting carbon neutral policies. At one time, they didn't care about where their energy came from, but now they do. Even Royal Dutch Shell, which is one of the world's largest oil companies, is migrating toward low carbon energy. And I know you speak with a lot of world leaders and also leaders of major corporations. Do you get a sense that it's different this time, that the world is going to accept nuclear energy in a big way?
Well, I think that things have shifted a little bit, because people have realized that, yes, we need to make sure that we meet the decarbonization that we need for the climate change, but we need to do this in a way that, number one, is going to be reliable. So many of these industries that you have mentioned, they do require energy 24/7. And unfortunately, some of the other low carbon energy sources that have been deployed recently are variable. They don't have these 24/7 capabilities. So I think that we are seeing a lot of industry, a lot of major stakeholders that are very, very interested in not only the low carbon features of nuclear energy, but the reliability, the round-the-clock availability, and frankly, the affordability. Because if you look at nuclear projects, when you look at the lifelong investment, I mean, we are looking at an investment that is going to be 60, 80, 100 years of guaranteed low carbon, round-the-clock electricity. That is something that many of these industries are looking with a lot of positive view. So that is one thing. But another thing that I think is just as important, many times in the dialogue for climate change or in the dialogue towards decarbonization, we have seen a scarcity mindset. So you have seen how we were saying, oh, developed countries, they need to stop doing what you're doing. You need to stop eating meat. You need to stop, flying or things like that. And I think that one of the things that nuclear energy brings is the possibility to not only decarbonize, but do it in a way that everybody in the world, not only we in developed nations, but all these other millions, 1 billion people that currently do not have access to reliable electricity, also can have the energy and the quality of life that many of us enjoy nowadays. So I think that nuclear energy provides us a win-win. So not only we can decarbonize, but we can actually bring the standard of living of everybody in the world to what we all feel it needs to be.
Salma, I want to thank you very much for spending time with us today and also telling us about the World Nuclear Association. I would encourage our viewers to check out the WNA website. It's got a wealth of information on there, anything and everything you want to know about nuclear energy and also uranium. Salma, once again, thank you.
It is my pleasure. Thank you so much, James.
Hi, Askar. Thank you for joining us today. It's good to see you again.
Hi, James. It's likewise. Almost 1 month no see.
Askar, since our last discussion, there's been a lot of new developments at Kazatomprom, and I want to dive into these new developments. But before we do that, why don't we just begin with a brief overview of Kazatomprom?
Absolutely. I'll try to be very brief here. So Kazatomprom is the world's largest producer and seller of uranium, supplying the market with about 23% of the primary production. With our 12 joint ventures and 2 fully owned assets, all located in Kazakhstan, we control over 40% of the primary mine production. At Kazatomprom, we have more than 20,000 people working on shifts and at the offices. So our low-cost production occupies the entire first quartile of the production cost curve, thanks to the flexible and scalable in-situ recovery mining method, which we use at all of our operations. And as a national operator in Kazakhstan, we have priority access to Kazakhstani deposits, which we can develop and which contain the largest ISR reserves. So just mentioning about ISR method, ISR is the mining method which provides us with a very strong and environmentally friendly method. It has also a strong governance framework in place, and we also continue. That also allows us to continue to improve our already robust ESG profile. Some words on our strategy. So our market-focused strategy enables us to increase the number of customers and also geographies where we sell to. And finalizing it, it's all underpinned by the strong financials and commitment to sustainable returns to our shareholders. That's kind of very brief overview of the Kazatomprom.
And we should also mention the ISR method is also very economical and very profitable and much cheaper than it is traditional, conventional type of mining. But maybe you can just tell us on a per pound basis, what does it cost you to produce a pound of uranium?
So with ISR method, yeah, it's very ecological, it's environmentally friendly, but also it's cheap in terms of mining if you compare it to other traditional methods of mining, like open pit or underground mining. It all comes up to all-in cost is around $15 per pound, which kind of puts us in a very good position in terms of cost.
And one other element I want to touch on before we touch on the recent developments, but in 2018, Kazatomprom implemented the value strategy, and this really changed the course of the company. Maybe you can just tell us about that strategy and how it changed things in relation to your previous strategy.
That's a good point, James. I'll not be deepening into the history of ourselves to kind of going into a vertically integrated company, kind of through exchange of the technologies with our JV partners. But I'll mention that we are currently presented in all parts of the front end of the nuclear fuel cycle. So when it really came for an IPO in 2018, we knew that in order to attract new shareholders, we had to ensure our strategy was focused on a long-term value. Well, that meant focusing on the parts of that nuclear fuel cycle that generates the best margins, which is obviously mining for us, and the lowest cost way to mine is ISR that I mentioned. Within that strategy, we also focused on growing our contract book through enhancing our marketing advantage and kind of contracting more new customers in different parts of the world, kind of to make the better aligning of our production with the demand that we see as coming.
So in essence, there was more focus on controlling the production as opposed to dumping a lot of produce onto the market. You did so in a very controlled manner.
Absolutely. So we've started implementing this strategy when we had seen that the market is, let's say, that had a lot of overproduction on it, and by our legislation, by our mining code, we have a flexibility for plus and minus 20%, where we can flex up or down our production. So that was our decision not to change the subsoil use contracts, to go to the minimum level, allowable level on that contracts, and produce at minus 20%, which is already this year is the 5th year. We've announced it for 2022 and also extended the same vision for 2023.
So that's a great overview of the background on Kazatomprom. Why don't we move on and touch on some of your recent developments? In early November, you released a trading update. Production guidance decreased slightly to 21.7 to 22,000 tons versus your previous guidance of 22.5 to 22.8 thousand tons. Why the slight decrease?
Yeah, you're absolutely right mentioning that. We have a slight decrease in our production. It all relates to kind of COVID effects that we're still seeing, and general logistical constraints that we are having on the market is impacting ourselves as well. We have some parts which we need to produce pumps. We also need some chemicals to produce our plastic pipes. So all of these are coming from abroad, mainly from China. And due to the very difficult logistical situation that we have on the border of Kazakhstan and China, and I mean, every country dealing with China have these problems now. So we were not an exception, unfortunately. So because of that supply difficulties and late deliveries, our local producers cannot provide sufficient amount of pipes, pumps, and some other kind of spare parts that we need for our production. That actually caused that small change in terms of guidance, and we're expecting that we will not be kind of fulfilling that production target that we have set in the beginning of the year.
And your C1 cost also increased slightly to a range of $9.50 to $10.50 a pound. Can you also explain why?
Absolutely. This fact also relates to the supply chain. You know, we just not only didn't receive, or we received them late, but also delivery cost has increased. The cost of the materials that we were trying to buy from other locations were also more expensive than it was kind of expected usually. So all these things cause this very small change in terms of production cost, which, I mean, was reflected in our guidance. So all things are kind of interrelated and causing these small changes that we are seeing.
The other big news had to do with the signing of 2 term contracts with China National Uranium Company and also State Nuclear Uranium Resources. Do you always announce when you enter into contracts?
Actually, no, we don't always announce signing of those contracts. So I would like to kind of thank and congratulate our sales and marketing team. They've done a phenomenal job. I mean, most of the market knows that China was not signing long-term deals for quite a bit time. So these 2 deals are actually good deals, and that's the hard work of what we were always saying, that we were focusing on increasing our contract portfolio, having long-term contract. And something to mention on that part, I mean, we are restricted with the confidentiality part of the contract, so we cannot say the length and the volume of the contract, but we have a market-related portion in both contracts, so that's a good thing, and we're anticipating this growth of the market would give us a good value when we will be selling under these contracts.
And as you mentioned, I know you can't discuss any of the terms or details associated with the contracts, but I'm always curious how long it takes to enter into these discussions and how much back and forth there is. Can you give us some sense of timing? Like, does it take a month? Does it take a year?
Well, it is always different from customer to customer and from market to market, I would say. So China is very different in terms of negotiations when you negotiate with US, European, or Chinese customers, especially when they are related to government. But this time the discussions were not that hard and were not that long. Usually in the past, those big contracts kind of were taking for more than 1 year. This time we were quicker than 1 year, but kind of the preparational work to discuss and to bring all these discussions on the table, I mean, most probably had a couple of years before this year that we were constantly communicating and discussing with them. So the discussion themselves were very quick, very straightforward. We know both companies very well. They are our good partners. So it was rather easy to discuss with them and kind of find those kind of points where we could agree on mutually beneficial terms of the contract.
So let's move on and talk a little bit about the spot market and the term market. And you also have a trading arm that you use for gathering market intelligence. Can you tell us what they're seeing in the market?
Yeah, I mean, I would say from the mid of August, market became very active. In the mid of August, we've seen utilities returning back to the long-term contracting and let's say mid-term contracting as well. Even though it was not the case in the previous years, they were usually coming in September, and all the discussions started after WNA, which is in the beginning of September. This year it's slightly different. Maybe everyone was anticipating that the Sprott was coming to the market. So some of the utilities were very lucky to get the volumes before Sprott entered the market. After that, even when Sprott entered and made this huge price volatility, we had seen the price going up to 50, then back to 37, now again back to mid of 40s. So utilities are still on the market. We're seeing more and more discussions. Discussions became really long-term. Some of the requests and tenders are going up to 2030, and there is already a couple of tenders that are going over 2030, which was not very kind of usual thing before. So that's a good development. Utilities are really concerned about security of supply, really concerned about existence of the material, and I hope that kind of the fact that spot market is not a sustainable source for long-term supply is now a clear fact for everyone.
In October, Kazatomprom announced an investment in a physical uranium fund called ANU Energy. The fund will hold physical uranium as a long-term investment similar to Yellowcake and the Sprott product. What was the purpose of being involved in this fund?
Very good question, James. We are having these questions and discussions very frequently. I mean, that was the part of our strategy which we had. So we have seen the interest into the uranium sector from investors for a long time. I mean, UPC was existing already for some great time. So as the interest picked up and we have seen more players coming, there were parts of the market which were also very interested but very cautious from investing into the uranium because of the nature of the product. But as we had seen very successful entries like Yellowcake, like Sprott getting kind of buying UPC and doing a phenomenal job this year. I would say that more and more investors were were very excited by that good example, and we're seeing much more potential that is still unrealized on that part. So with all the approaches that we have and we're still having, with the request just to invest into the physical uranium, that was a trigger point and decision for us to invest in one. This one would be in Kazakhstan. It will be placed at AIFC, so it has a good investment climate. So basically, the kind of seed investors is ourselves and National Investment Corporation, which belongs to National Bank of Kazakhstan, and we have an independent partner here, Genchi Global. So we are investing $50 million initial investment, and we will have independent manager of that fund that will be kind of executing the second stage. Just recently, we had an official opening and signing ceremony of the framework agreement for that fund. So the reason for us to go for Kazakhstan and finding the partner that could kind of transfer all this interest into the contract. So our partner have a good connection on the Middle East, in Asia, the markets which are not very well covered within the current two funds that we have. So what was very important for us is to make sure that this material would not be returning to the market. So we have those conditions in the framework agreement, which are tied both to price and to the timing that has to be that has to be applied for the storage of the uranium within the fund. And the fund cannot sell the full volume instantly to the market, so it has also some annual cap there. And one important thing to mention is Kazatomprom will be the ultimate seller to the fund, and we will have a first refusal right whenever the fund would like to sell the material back to the market. So that are the kind of main conditions. The rest would be handled by independent manager of the fund that will decide the second stage, how it will go, whether it will be private placement or IPO. So kind of that will be a decision of kind of independent manager. And I mean, if at the end of the day we will be very successful with the stage 2, then it's again up to the decision of manager of the fund whether we have to grow the similar thing but which we've seen with Sprott. So initially they had 300 million and then they've increased it up to 1.3 billion USD. So I mean, with all this great interest from investors to uranium sector, I mean, we're also very excited to start that fund.
And I was going to ask you from an investor point of view, how will the ANU Energy Fund be different from Yellowcake or the Sprott product? But it sounds like you're going to focus more on Asian investors. Is that correct?
Well, at least we're seeing the interest from that sectors, and kind of, I cannot say whether it will be just Asian investors or it will be globally, but initially, kind of fund manager is working with Middle East and Asian investors, but kind of we cannot rule out that there will be investors from US, Canada, or maybe Europe as well.
And I want to ask you one more question in terms of pricing, and I just want to hear your views on this. We have all these financial players involved in the market. They've been very active in buying up supply, and there's so many positive developments coming out that from a demand point of view are very strong for uranium going forward, just with the increase in the numbers of nuclear reactors being built, this whole push toward a green economy. Why isn't the price of uranium higher right now in both the spot market and the term market?
Well, that's a good question. I think it's more maybe related to price forecast companies like UEX or Tribeca. But I mean, in terms of what we see and what we think, further the price increases. When the market was at 30, there was not much people willing to sell at 30. There could be different reasons. Maybe the cost of the inventory they were holding was much higher. So the higher you go in the price, the more material is available to be sold. I mean, I'll give you one good example is Japanese inventories that are held by Japanese utilities. Some of those utilities will not be able to restart back. So, but they've bought all this uranium at very high cost at the contracts that they have signed at pre-Fukushima period. So the higher price goes, then the more interested would be those utilities to sell the inventory that is actually very expensive for them. They cannot sell it now because they will have to account the loss, and that's not what they want. So the higher it will go, the more material or the more players would be willing to sell the material that is just differently priced or have a different cost. So I mean, maybe that's one of the reasons that we see. And when the price is at 50, we have more and more sellers and more people offering the material.
Great comments. Kazatomprom and China General Nuclear Power announced a JV whereby China will build a strategic stockpile of uranium. Can you provide details of this arrangement?
Yeah, at the moment it's not a JV. It's completely Chinese warehouse, which will be kind of located at border of Kazakhstan and China at the place called Alashenko. So that warehouse is the next announcement that China have made after announcing their 14th five-year plan, which actually shows that they are going to accumulate some good stocks to support their future nuclear program. And as we saw from the presentation of CNUC, the capacity in 2026 is targeted to be 23,000 tons, which is double of Kazatomprom's attributable annual production, almost double. So they are indeed indicated that they will be inviting the partners to become a JV partner, maybe there to have some stock, but that will most probably be related when the warehouse is going to become a trading hub, which would be a fourth trading hub in the world. So that's their target. I mean, that would be very interesting if that happens, and if that will develop in a trading hub that will have its own kind of index and price. In terms of current discussions, we are in advanced stage of discussing it with CNUC. We are willing to become a strategic partner, and as long as it was announced to be in the border of China and Kazakhstan, I mean, it's obvious that all the production goes from Kazakhstan. So that's the kind of additional, I think, program of China which will be supporting their future nuclear new builds.
Askar, we touched on a lot of recent developments, but as we wrap up, is there anything else you would like to communicate to the market?
Well, recently we also had an announcement on our third quarter financial results. One thing to highlight there is our sales performance in the third quarter this year was not as high as it was in comparison with last year. But mainly, I mean, this was because we had some shifts in our delivery schedules, which was requested by our customers. So indeed, in fourth quarter, we will have a big chunk of the material to be sold and delivered to our customers. But I mean, as we announced in August, we have completed and committed our sales plan for this year, and fourth quarter would be very busy just in selling, delivering, and issuing the invoices, but we will definitely hit our sales targets and deliver everything which is committed to our customers. In terms of the second part of that announcement which we've made, we've announced that we are bringing another asset online. When we were at IPO stage, we showed some perspective mines that we had, and this one is the first one. So after the 5 years being at the exploration stage, by the law, we had to move it into the production stage or return back the contract. So we've moved it to production stage, and we're just following what we have to do in accordance with our subsoil use contract. So we're doing it to offset the assets that are coming offline. We're expecting 2 mines to go offline by 2025. So kind of we have to offset them with the new production, and also with this increased inflation and kind of things becoming more and more expensive, we have to balance our cost structure. So introducing this very good asset now and bringing it into the production in the second half of this decade, I mean, will help us to maintain our cost advantage that we have, and as I said, to balance the cost structure, current cost structure, and make it even more attractive for our shareholders. And one thing also to mention is the impact on the market would be considered only from 2027, as the first 3 years of the commercial production of that mine is already contracted, and we haven't signed an offtake agreement with one of the buyers who will be using this production for their nuclear new builds program in the future.
So Askar, just to clarify, you have assets coming offline in 2025. These new assets are going to start producing in 2024?
Yes, that will be coming on 2024, and we have 2 assets. One of them is going offline in 24, another one is in 25.
Okay, and the first 3 years of the production from the new assets, it's already been sold?
Absolutely, and it will not be coming to the market, so it will just be kind of removed to the end user, which they will be using for their nuclear program.
Askar, as we wrap up, 2021 has been a very busy year for you and your team in terms of news flow. What can investors of Kazatomprom expect in 2022 in terms of news flow?
Yeah, very good question, James. I think investors should be expecting that we will definitely keep to our strategy. We would be focusing to complete the stage 2 of our Kazakhstani originated uranium fund. We would definitely hit our sales targets, and we would be focusing mainly on the discussion with the utilities and trying to help them to give them the security of supply for the long term. So hopefully we will have more and more announcement about our current work and our current discussions with utilities in terms of long-term contracting. I mean, that's for now. if we have any other ideas and developments, we'll definitely communicate it later.
Askar, thank you very much for spending time with us today and sharing your recent developments and giving us details on those developments. Once again, thank you.
Thank you, James, for inviting. It was a pleasure and hope to see you soon.
Hi, Ian, and thank you for joining us today. How are things in Perth?
Thanks, Jimmy. Great to be talking to you today. Yeah, things are lovely in Perth. We're coming into our summer period. So yeah, very nice time of year over here in Western Australia.
And are things getting back to normal?
Yes, we've been very fortunate over here on the west coast of Australia. We actually haven't had any COVID to speak of whatsoever. So we've been quite isolated during the last 18 months, and life is running pretty well as per normal. But we are looking forward to opening up to the rest of the world next year.
Ian, let's start with a brief overview of Paladin Energy and your various operations, and then we'll do a deep dive on those operations.
Thanks, Jimmy. Paladin is a significant player in the global uranium market. We've got a wonderful operation in Namibia, the Langer Heinrich mine. It's currently in care and maintenance, but previously has run very successfully for a period of 10 years. It was put into care and maintenance in 2018 due to the very, very low uranium prices. A similar decision to what Cameco took with MacArthur, protecting the value of the resource. So that asset in Namibia is sitting pretty well ready to go again when the uranium price is right. We've also got a very extensive exploration portfolio with some very large projects in the east coast of Canada and 2 very large projects on both sides of Australia on the west and east coast. So we've got a very interesting portfolio of near-term production as well as some mid-term and long-term opportunities.
Ian, as you mentioned, your primary asset is the Langer Heinrich mine in Namibia. Namibia is the 4th largest uranium producer in the world, producing approximately 10% of global production, but it's a country we don't hear much about. Can you give us a little bit of background on Namibia, just in terms of its political stability and also the importance of mining to the country?
Put bluntly, it's an excellent jurisdiction. I had the pleasure of getting over there last year before the world shut down. My project director's been over there this year, and we've also got a very strong team on the ground in Namibia of very experienced mining individuals who are all Namibian nationals. Jimmy, it is a mining jurisdiction. When I went across there, it reminded me of my time going to Botswana, going to Kalgoorlie in Western Australia, you know, all those great mining jurisdictions. Mining is part of the community. We're on the west coast around the town of Swakopmund, and it is a uranium mining jurisdiction. There's 2 very large uranium mines that have been operating and operate through today, and we're the 3rd one looking to get back into production. Excellent legislative and taxation framework, very well developed. There's been continuous uranium mining in the jurisdiction since 1976. And what I was really pleased to see is the level of expertise on the ground. There's also a deep water port, there's oil and gas industry. So we're very fortunate to have all of the infrastructure, all of the service providers, and most importantly, a very, very skilled mining workforce in the local jurisdiction. So I'm extremely pleased to have an operation in Namibia. And Jimmy, I think myself and certainly the rest of the team, we're just looking forward to getting back in country and spending time with our team. And apart from that, the Skeleton Coast over on the west coast of Namibia has some of the best surfing and fishing in the world. So it's not, Jimmy, I wouldn't call it a hardship location for people visiting. And I already have a list of major institutions who are desperate to come and visit our mine site when we're up and running.
Oh, well, that's good to know. So throw me on that list.
Yes, you'll enjoy it.
So let's move on and spend some time on Langer Heinrich. As you mentioned, it's a past producing mine and it's currently on care and maintenance. Can you give us a little bit of history behind the mine itself? When did it start production? When did it go offline?
Langer Heinrich started in 2007. It's a conventional operation. It's Jimmy, I'd call it mining 101, and I like that. And the elements of a successful operation are you've got to have the metal in the ground, and at Langer the metal's in the ground. It's very good grades, the ore body. So that's the first thing. Secondly, you want a conventional mine and a conventional concentrator, nothing fancy. That leads to success. Langer Heinrich is a series of shallow open pit mines, very straightforward. The plant is relatively simple, very conventional, and worked very consistently over the 10 years it was in operation. So the operation started in 2007. There was a series of upgrades done over the next few years, which were all successful, but they were done quite quickly. And Langer Heinrich was very successful, but never really ran steady state because it was always upgrading. When it achieved steady state at its larger production base, unfortunately, the uranium market started to deteriorate rapidly. And that's when the operation was put into care and maintenance. But when you go back and look at the 10 years of operating history, which we have, it shows a very successful processing plant, a very simple mine, and it shows a very consistent product. So every shipment that left Langer Heinrich was within very predictable specifications, and the customers were very pleased with the quality of the product. So it was, in summary, a very successful operation. The processing, the cost base, everything's well understood and well documented, and there's a strong empirical basis to it. And it's quite a simple operation when all's said and done, and hence we have a lot of confidence that we can restart that operation very successfully.
Ian, in June of 2020, you announced a restart plan for Langer, and you recently came out with an update on that restart plan. Can you just take us through the main points of the update?
Yeah, Jimmy, we've done about 3 years solid technical work on the restart plan now. And the reason we've gone so deep into the restart plan, quite frankly, is because we've had the time. We've been in care and maintenance. And we've had several different parties, external parties, internal parties, look at different options. And it's probably not surprising, the fundamental conclusion we've come to is we're going to restart and run the operation in a very similar configuration to what we did previously. So we've got a very good understanding of how the operation will look, how much it'll cost, and what the production metrics are going to be. We've also identified 3 or 4 major areas of improvement. One of the benefits we've had is we've got the collective experience of 10 years of operations, and there were some areas where the prior team and the independent experts agree that we can do it better. So we're going to take the opportunity to make those improvements, which are all about mining efficiency, getting the mine and the plant interface absolutely perfect, as well as getting the mechanical availability in the plant. So the plan is to restart the way we used to do it, but with some improvements. And we factored all that into our capital estimates, our operating costs, as well as our ramp up time. So we ran for 10 years. We've got another 17 years of reserves today, and we're very, very confident in all of our metrics and guidance. And you would have noticed with the restart plan that we did last year and the update we've just done recently, the metrics are very similar. And that's because those metrics are based in that 10-year operating history and not based on a theoretical spreadsheet. They're based in reality. So that's why you've seen that consistency of guidance.
And Ian, I just want to clarify one point. You said you can restart again within 18 months?
Yeah, so Jimmy, we've done a base case schedule which is matched to the utility, our customer requirements. So our customers are approaching us at the moment looking for production 2.5 years out. That is generally the contracting cycle in a standard market. So we've got a schedule that matches that, which I'd have to say is very comfortable for us. One of the opportunities we're looking at the moment, if we do find that our customers have left themselves a little bit exposed in that midterm horizon, and maybe they are a bit surprised that they need some uranium faster than they expect, could we meet that requirement? We think the answer is yes. We think we could start quicker. And we think that could be an opportunity for us maybe to get some opportunistic pricing. But the base case is our customers will require material 2 years out. Can we meet that time frame with a lot of comfort and a lot of confidence? Yes, we can.
And Ian, now that you have a well-defined restart plan, what other upside options are you exploring beyond the base case?
So our priority up to this point in time has been all about the base case. And we really, really wanted to get into detail on that base case because we expect to deliver this plan in the near to midterm. So we wanted to make sure what we said to the market and what we said to our customers, we had a very, very high level of comfort. And we've now achieved that. As I said, we've done 3 years work and we're still at the same point. We're very comfortable. What's exciting, Jimmy, is as you referred to, that's what we call our base case. And now we're starting to look at the upside cases for Langer Heinrich. I can categorize them in 3 major categories. There's the self-evident operational optimizations. And the obvious one is the current base case says that our production levels step down in year 10 when we move from the mine to our stockpiles, which, by the way, are very good grades, our stockpiles. We think we can claw back some of that production with some simple modifications to the plant. So, for example, the key limiting factor on production in year 10 is a crusher. We've got 2 crushers. You put 3 crushers in, all of a sudden your production comes back. The other one is we see opportunities to improve the recoveries. We see opportunities to improve the cost. And the interesting one is we've got a mine plan at the moment, which is based on a fairly conservative uranium price, and it makes sense at the restart. As the uranium price moves up, there's an opportunity to increase our ore going through the mill by dropping our cutoff grade. So currently our cutoff grade is 250 parts per million, which when you look at some of the other proposed projects in Namibia, that is very, very high. So what we're doing, we will be stockpiling what we call marginal ore at the moment, which is not part of our reserves. And we'll be stockpiling that separately. And we believe at some stage that will be economic. So we think the resource base will naturally expand over time and production will go longer than expected. The second category of improvements is what we call new technology, ore sorting, and a range of other technologies have got the opportunity to fundamentally change the length of life and the economics of our mine site again. And certainly ore sorting is one we're very interested in. We don't think it's commercially there at the moment. Technically it's there, but there are a lot of mining companies doing a lot of work at it. And we think over the next dozen years, that's certainly something that will come into play. And the third opportunity, which I'm very excited about, is you're probably aware we've just appointed a new general manager exploration, Jess Oram, very experienced uranium chap. He's having a look at the ability to extend our resource, which he's very keen on, but also other exploration opportunities on our tenements in Namibia. And there's some exciting longer term prospects there as well, Jimmy. So in summary, lots and lots of upside. We're going to be looking at concept studies of all of those opportunities, and we'll talk to our shareholders more about that as we progress through 2022.
Ian, I don't think we mentioned this earlier, but Paladin owns 75% of the Langer Heinrich mine. China National Nuclear Corp, or CNNC, owns the other 25%, and CNNC is one of the largest utilities in China. And so I want to get your thoughts on what the Chinese are doing. I don't know if you can share that given your relationship, but why don't we just take a step back and tell us how that relationship with CNNC started?
CNNC took a position in Paladin in the Langer Heinrich mine with a deal with Paladin in 2014. They bought 25% of the shareholding of the holding company of the Langer Heinrich operation. So we're co-shareholders. It's not a joint venture. We're co-shareholders. They also signed a life of mine offtake as a strategic customer, which is an excellent offtake. We really do like that offtake. The reason being, it's a life of mine offtake for 25% of our production, and the pricing mechanism is a clean market pricing mechanism with a small commercial discount against the benchmark spot price on the day. What we like about that is we really like that spot price exposure. There is no ceiling, there is no floor. It's just clean market exposure. But the beauty of this opportunity for us is we get that clean spot price exposure, but every one of those pounds goes to China. They don't hit the spot market, the actual uranium spot market, which is a terrific offtake for us. So we're very pleased with that. CNNC have taken a lot of product from Paladin before the care and maintenance program. From talking to the ex-team and from talking to CNNC, they were very reluctant to go into care and maintenance. Their preference was to stay in operations. And I note that our partner is running the Rossink mine in Namibia and shipping uranium into China every week. So it's been a very good relationship. It's not without its challenges historically. But what I particularly like about the relationship is we are the operator. We make all the decisions. We decide when we restart, and we decide how we run, when we run, and who we sell our product to. So it's a very good position to be in. I obviously can't speak too specifically about our ongoing conversations with our partner. There's been a change. There's been a change in intent at a Chinese national level in regard to uranium. I think we've seen the announcement from Kazatomprom recently, and we've certainly seen that with our partner. Our partner has given us a very strong indication they would like to restart Langer Heinrich as soon as possible, and they're certainly very interested in talking to us not only about our existing offtake, but whether there's opportunities to do more together than we're currently doing. So we've seen a very, very strong change in intent from our partner. And we think that that's maybe a bit of a sign that maybe, you know, the uranium market generally is starting to heat up a little bit, if I can put it that way.
All very positive. And we also saw in the last couple of weeks that China announced that they want to build 150 nuclear reactors over the next 15 years. So I guess they're getting ready for that. They need lots of inventory.
Yeah, I think so. And I think what the Chinese utilities have done extremely well previously is, you know, they from my experience, they tend to take a very long-term view on the supply of critical raw materials. And there's only one material that'll power a nuclear reactor, and that is uranium. And I think the Chinese have taken long-term views on uranium, and I think they've taken the latest view on uranium, and with their nuclear utility build out, and with their current fleet, and with their plans, clearly they are keen to source more uranium and lock in long-term uranium. And I think that's very smart. And I noted some of the comments from Kazatomprom. I think Kazatomprom think it's very smart. And I heard Grant Isaac from Cameco talking the other day. And I think all of us are sitting here thinking, yep, we think maybe China are on the move again.
Interesting comments. So let's move on and talk about your exploration properties. You do have 3 of them, 2 in Australia, 1 in Canada. And why don't we start with the largest of the 3, Mount Isa. It's got 148 million pounds in the measured and indicated categories. Can you just touch on that, please?
So the exploration portfolio is, again, a very exciting opportunity for us. It's laid dormant within Paladin since probably 2010, 2011, because the company had other priorities, and certainly with the economic macros that we saw in uranium, no one was terribly interested in talking about uranium exploration. Pleased to say we've earned the right to talk about uranium exploration. We've done all the housekeeping. We've got Paladin in really good shape, and our shareholders are starting to get a little bit excited about that portfolio, as they should be. So our approach, Jimmy, is very conservative. We're looking at doing modest work on those assets. There's been a mountain of work done on all 3 assets historically within Paladin, and we're looking at a modest program that we've just started that journey again. But what's really important is we want to have a very clear pathway forward beyond Langer Heinrich. So when we deliver Langer Heinrich, and we're starting to see cash flow, and we've got commercial production out of Langer Heinrich, we will be ready to press the button on our next sort of development exploration opportunity. So that's what we're doing. We're looking at those pathways now.
Very good. Ian, I want to move on now and touch on your balance sheet. And can you tell us what your cash position is?
We're in a very strong position at the moment. We're very, very fortunate to have had terrific support from our shareholders and new shareholders. Jimmy, we cleared all of our debt position earlier in the year, and that's put us in a very strong position. We currently have around $40 million US in the bank, free cash flow. So we're in a very, very strong position. We're very well funded. So when we talk to our potential customers, we come to them with a lot of confidence. And the conversation goes along the lines of, we'd love to restart. We'd love to supply you again with the material that you got from us previously, but it has to be at the right price. We have to make an appropriate return for our shareholders. We're not a charity. And we have confidence. We're not in a rush. We have cash. We have no debt. And we've got an asset that's ready to go, but we're not going to turn it on until you pay the right price. So that's been our conversation for the last 2 years with our potential customers, and we're sticking with that. And fortunately, given our financial position, it's allowed us to be very, very disciplined in the market.
Ian, you're currently listed on the ASX and also the US OTC market. Do you have any plans on uplisting to the TSX or the NYSE ARCA market?
We think we will, Jimmy. We think that makes a lot of sense. The company was previously listed on the TSX. We think having a North American Canadian listing is very complementary for a uranium company that's listed in Australia. The question probably is when makes sense, and given the cost of the listing, it certainly wouldn't be before we're back in production. But I think at this stage our feeling is once we are back in production, we would love to have a North American or a Canadian listing. We have terrific shareholder support from both Canada and North America. And we believe that dual listing structure for us, particularly being uranium, we do think that makes sense for us, but at the right time.
Ian, as we wrap up, what can investors expect in terms of news flow from Paladin Energy in the coming months?
We're a little bit excited. We've done a lot of hard work, and we've got the company exactly where we wanted it at the start of what we're seeing the next uranium super cycle. We were very keen to get ourselves to the start line in the best shape we could. We're very pleased to have achieved everything we set out to do 2 years ago, and we're at the start line. And Jimmy, internally, we've got all those upside opportunities we talked about at Langer Heinrich. We've got a fantastic development exploration portfolio of advanced projects. So we've got a lot of work to do and a lot of good opportunity to bring forward some of those upsides and opportunities beyond Langer Heinrich. More importantly, the team, myself and my board, we're starting to get a real conviction that we think we will be potentially signing contracts in the first half of next year at our starting price, the price we've set ourselves to get back into the game. We think the uranium market is moving rapidly. We think with our views on China, what we've seen with the US utilities starting to come back to the RFP market, and the other factors we're seeing with small nuclear reactors, as you mentioned, 150 new reactors in China, France, UK, the infrastructure bill in the US, the EU taxonomy, we're seeing some very, very positive catalysts. So we're going to be very active next year. We think we'll be moving forward and starting our production journey again first half of next year. That'll depend on the uranium market, obviously. And in the meantime, we'll be continuing to drive very hard with our upside opportunities and looking at our exploration pathways. So we're very excited. We've had a really excellent 12 months at Paladin, but we think we're just at the start line.
Great comments, and thank you very much for sharing the Paladin Energy story with us today. And to all of the viewers, if you have any further questions for Ian and the team at Paladin, please send us an email to info@bloorstreetcapital.com and we'll get you an answer to your questions. And if you would like some research on Paladin, shoot us an email and we'll send it along. Ian, once again, thank you, and make sure you keep me up to date on that site visit to Namibia.
Will do, Jimmy. You're now on the list. Thanks very much.
Hi, Mark. Thank you for joining us today. How are things in Denver?
They're great, Jimmy.
You're all ready for ski season?
Well, when we get some snow, there's a bit of snow in the mountains, but not a lot in Denver at the moment.
Mark, Energy Fuels is unique in the sense that it's a US-based uranium producer, but you also have a rare earth component. And I want to touch on both of these elements. But before we do that, why don't we just begin with a brief overview of Energy Fuels?
Yeah, look, Energy Fuels has a long history of being a significant uranium producer. We've actually been the largest producer of uranium for the last several years, actually. We've got more assets. We got 3 production assets that are already fully permitted and constructed and fully paid for with a long history, production history successfully. So, yeah, there really isn't a company you can compare Energy Fuels to because of our long history in producing uranium and the emergence of production of rare earths in the United States, which is advancing very quickly. So, you know, we're very blessed in the type of assets we have and our long history of being doers, not just talkers.
That's a great overview. So why don't we begin with your uranium assets? As you said, you have 3 producing mines all in the US. Why don't we just begin with a brief overview of Alta Mesa, which is an ISR mine?
Okay, well, Alta Mesa is on standby right now. It's in Texas. and it's been on standby for a number of years, but it is on a large private ranch, nearly 1 million acres of land, and it's basically just waiting for slightly higher uranium prices. We're almost there. I mean, the price of uranium is in the mid to upper 40s, and once we kind of push through that $50 a pound range in a sustainable way, we'll start looking at starting up various uranium projects on a case-by-case basis.
And why don't you touch on your other two assets, Nichols Ranch and also Pinyon Plain Mine?
Yeah, Nichols Ranch is also on standby. It's in Wyoming, and it has a number of well fields that are fully permitted, ready to go. And again, just waiting for slightly higher uranium prices, and we'll look at putting it back into production as well. So those are two ISR production facilities currently on standby. We currently have the White Mesa Mill, which is our conventional mill that is not on standby, and it's currently producing rare earths, but also is where we can recover uranium and vanadium as well. And the Pinyon Plain mine is actually a mine I built back in the late 80s, and it is an underground mine where we've sunk a shaft nearly 1,500 feet deep, and we're about 10 feet from the ore, and it is the highest grade uranium project in the United States, and we're basically about 10 feet from the ore, and we can be in production there within probably 12 months at Pinyon Plain.
And so if you were going to start up one of these mines tomorrow, which one would you pick one first to begin?
Yeah, look, it depends on the quantities we're looking at, but probably our first project to go into production is going to be Pinyon Plain, and mainly because it's, we believe, our lowest cost project going forward, and so that'll be the first, probably followed then by Alta Mesa in Texas, and then Nichols Ranch. So the beauty of Energy Fuels is we have a number of assets that we can mix and match as required, depending on the quantities of uranium or vanadium that we want to produce.
And you mentioned we're not quite there yet in terms of price. What would that price be approximately?
Well, it's north of $50 a pound. Really, the whole industry in the world needs something probably closer to $60 plus a pound. But once it goes past 50, with a combination of our assets, our inventories, and the various forms of uranium products that we can process at the mill, we can mix and match and come up with a very good economic outcome for our shareholders when it goes north of 50.
Mark, in your Q3 press release, you mentioned you were seeking out term contracts with utility buyers. How is that progress?
Well, I think the activity level has increased, and certainly the Sprott fund for buying and securing uranium has stirred up the fruit basket a bit, and is creating a bit of anxiety, I think, for some of the utilities. So, but yeah, we're bidding various proposals, and as I said, we're if you go back a year or two ago, there'd be probably $20 a pound delta of what we'd be willing to sell our uranium at. That delta is diminishing quickly by the moment, and right now we're getting very close to where we can start hopefully securing some contracts in that north of $50 a pound range.
That's a great overview of the uranium side of the business. Why don't we move on now? Once again, on the onset, we discussed that you have a rare earth component to your business. And I have to admit, I don't know much about rare earth. So why don't we just begin with a brief overview of what it is and why you decided to add it to your portfolio of assets?
Yeah, well, the rare earths fits perfectly with the uranium component of our business, because the very best feeds of rare earths contain uranium and thorium, and in our case, the more the merrier, because we have a long history recovering uranium at the White Mesa Mill. The demand for rare earths, as you're probably aware of, is expected to increase several fold. Many people say it'll increase about 5-fold in the next 10 years. And so we're in a very unique position. It's not often in your career that you have a distinct advantage in the world. And we have a distinct advantage because we have the White Mesa Mill and we have the ability to process monazite sands. And we're doing it right now. And we really have no limitation on how much monazite sands we can process at the White Mesa Mill. So we can recover the uranium, and we believe, and we can monetize uranium. Also, we believe we can monetize the thorium in due course while making a uranium thorium-free carbonate out of the monazite sands. So this is an exciting spot for us, and we're moving very quickly. And I believe we will be a world player in the rare earth business in the entire world in terms of scale and low cost in the not too distant future, looking out probably 3 to 4 years.
And I'm not familiar with monazite or monazite sands, but what is it used for?
Well, historically, it was a waste product. Monazite is produced as a byproduct from heavy mineral sands operations that are mainly focused on titanium, zirconium. So it's a waste product, and up until well, particularly the last few years, many of the heavy mineral sand producers have just been burying it and not recovering monazite because they couldn't deal with the radionuclides and the uranium. So now the focus on rare earths has shifted to where monazite is quite valuable, and that's why we're positioning ourselves using the White Mesa Mill, recovering the uranium and the rare earths. Is again such a unique position that we're in as a company. So it's been avoided for years, even though it's been known to be the best source of rare earths out there in the entire world.
And will you mine this product yourself, or will you seek it out from other sources?
Well, right now we're replicating the China plan. Right now, China is securing monazite from others around the world, and they're processing it. They're recovering the uranium and the thorium. So we're basically replicating what China's doing. They're not mining monazite specifically, but so we're replicating that plan. But we're replicating it in the United States of America at world standards and in a jurisdiction that is really so thirsty for being able to reshore our ability to produce critical elements like rare earths and uranium and vanadium. So right now we're looking at people to partner with us, both in the United States and around the world. There are a number of parties that are keenly interested to work with us for all the attributes that we offer with regard to our ability to process in the United States of America.
And how much are you producing right now?
Well, right now it's small commercial scale. We're producing probably in the order of, say 1,000 tons a year of heavy of monazite sands, which is about 5,000 tons REO. But we could ramp that up given enough feed very quickly. I mean, we could be producing over 10,000 tons of REO given the feed. We are securing feed from Chemours. They've been a bit short because they had some technical issues at their mines in Georgia and Florida. They're trying to rectify that and increase the feed. We are seeking additional feed literally as we speak. So yeah, it's small commercial scale, but the important thing is it's small commercial scale. And most rare earth producers are at lab scale, maybe pilot scale, and we're able to process right now hundreds of tons because we're doing it as we speak, but we can scale up to thousands of tons given enough feed in due course. So, it's a unique spot, and we're very excited about it. And I've been in the mining business for 45 years, and it's the best opportunity I have seen in my entire career.
And Mark, you mentioned, so you're doing 1,000 tons a year. You'd like to ramp it to 10,000. Ultimately, how many tons can you do annually?
Well, again, we've got to secure the feed, but we will likely permit for about 30,000 tons of REO, which is could be upwards of 60,000 tons of monazite sands per year. We won't certainly build that out immediately, but it is our goal to have a plant that is around 10,000 tons of REO, which would be initially about half the size of Linus's operations in Australia and Malaysia.
And what would that mean if you get it up to 10,000 tons annually? What would that mean in terms of revenues and also cash flow?
Around $400 million per year of revenue. I do not want to go into in terms of profits. It's very robust. So I'll tell you, this is a remarkable opportunity with our focus on monazite, but we believe it will be one of, if not the lowest cost operations in the world if we're able to secure our plans and strategy as we're moving it forward.
And that's quite meaningful then if you get it up to 10,000 tons or 400 million a year.
Absolutely. And the fact that we started this journey about 18 months ago and the progress we've made, many people say that at Energy Fuels, we do more in 1 year than most people do in 10 years. And our very close associate, Konstantin Karyanopoulos, that many of your viewers will probably know, says that the work we're doing at Energy Fuels with the focus on monazite is a game changer in the space. So recently I was in London at a rare earth conference, and I have to say I was staggered by the attention that we're getting worldwide in this sector.
And do rare earth stocks trade at a higher multiple than uranium stocks?
Well, it's a good question. You know, it's really interesting that very few of the uranium companies, you know, actually are operating at a profit right now. I mean, or it's very marginal, you know, when you look at even where the price of uranium is right now. But look at when you look at, you know, Linus and in MP, yeah, they trade at substantial multiples. But they have market caps of around $5 to upwards of $7 billion a year, and you know we're currently at about a market cap of about $1.5 billion, and we're going to chase them. We're going to chase those market caps because we believe we have a unique business plan in the sector.
Can you process both monazite and uranium at the same time through your mill?
Right now, we have to flip the mill back and forth, which isn't completely optimal, but it is certainly possible. Our plans are to build out full integration, including separation of heavies and light rare earths, and also do sort of an addition to the mill to allow us to do both processing of uranium ores and rare earths simultaneously. That addition will not be hugely expensive. It might cost us $10 million or $20 million to have that, but we plan to do that when we build the separation facility in the next few years.
You've mentioned the White Mesa mill a couple of times, and I just want to reinforce how unique this part of the Energy Fuels story is. Just tell us what it is about this mill that makes it so special.
Well, it's the last operable facility in the United States, and it has huge capabilities. It's got probably a replacement value of $300 to $400 million, assuming you had the permits. Permits for a facility like White Mesa are extremely hard to get in today's world in the United States or North America or the world in general. It also has this flexibility of being able to process uranium, vanadium ores. It has a long history of doing recycling, which is the reason it has stood the test of time in difficult markets, because we've been able to generate revenues, and now to process the monazite that contains uranium, recover the uranium in the rare earths. So this facility, the White Mesa Mill, is becoming the most significant critical mineral hub in all of North America. So we're repurposing a facility that has vast potential.
And Mark, you mentioned the replacement value would be $300 million, give or take. But in order to get the permits and also to build it, if you were going to duplicate it, how long would that take?
That is a really good question. It depends on where the jurisdiction you're trying to build it in. But yeah, I mean, typically people say it would take maybe 10 years to get the permits alone. The facility is located in the state of Utah, which is a great jurisdiction to do business. It's mining friendly. We have 5,500 acres of land, private acres, so we're on a very large land position, which is excellent. And also we have a great workforce in the southeastern Utah, in the Four Corners region. Really salt of the earth people that can do amazing things, and they don't take no for an answer because they're very resourceful.
And are you only going to process your own material at the mill, or do you have any milling agreements?
We have one milling agreement right now for uranium, and that's with Consolidated Uranium. We're going to be very selective on milling agreements with regard to uranium and vanadium. With regard to rare earths and monazite, currently we're not planning really to do milling agreements, but we are looking at creative ways to partner with others to get and secure monazite sands at very reasonable acquisition prices in partnership to end up with a very cost competitive arrangement for us and those that work with us.
So that's a great overview of your various operations in the mill. Let's move on to your balance sheet. How much cash do you have?
We currently have about 100 million US in treasury. If you add up some of our inventories and tradable securities, last reporting period it was 130 some million. But since then, and that includes uranium stockpiles and vanadium stockpiles at book value. If you go to current prices and you look at the divestment of the assets we made to Consolidated Uranium, we have well north of 150, probably close to 175 million cash, working capital, inventories, or tradable securities.
And you're sitting on a lot of cash. How are you going to allocate that in the coming year?
Well, you know, this market's moving very quickly. I mean, we certainly have the strength and the capacity to allocate towards uranium as we open up mines, but also our rare earth strategy. So, you know, it's going to be dynamic. I would say that, you know, I mean, to get our uranium focused production going, we probably need somewhere in the order of, say, upwards of $25 million of mainly working capital for the uranium side of the business. For the rare earth side, we don't need huge dollars until we start to look at building out the full integration at the mill, which would be in a couple years' time. So, you know, we'll be dynamic, but, you know, we're going to push both of those areas based on their merits. But as I said, it is very exciting because an investment in Energy Fuels is an investment in reducing carbon emissions and electrification both on steroids. No other uranium investment or rare earth investment offers the diversity that we're able to give our shareholders based on the elements that we're able to produce.
And I'm sorry, how many pounds of inventory do you have in uranium?
We have about 700,000 pounds of uranium finished goods in inventory. We have nearly 1.7 million pounds of vanadium in inventory. So it's interesting that if you look at the delta from what we have it on our books compared to current prices, it's about over $20 million in price increases above book value. So, you know, we have, you know, kind of pushing $50 million of inventory at current prices.
And at the right price, would you sell that uranium to a utility or a financial buyer?
Everybody always has a price. And at the right price, we'll sell anything that makes sense. So Yeah, look, right now, it just gives us a lot of flexibility, both on the contracting front, you know, and the fact that it is you know, finished goods and ready to be moved into the market very quickly. And and I also want to say that our uranium and vanadium, we produced it ourselves. We didn't buy it. So we can produce uranium, vanadium, and we can produce rare earths, and we can prove it because we've done it.
Mark, as we wrap up, is there anything you would like to communicate to the market that it might not understand about Energy Fuels?
Well, I think we've traded as a 100% uranium play, which is fine because the uranium space has been on fire, and you know, we've gotten substantial share appreciation, as have other uranium producers. But I do not think we've gotten really realization on the value of the rare earth play, which, as I said, when you look at people that are currently producing Linus and Mountain Pass, you know, they're $5 to $7 billion companies. So I think the opportunity for the biggest growth right now is a revaluation of our rare earth capabilities, and you know, I believe that's coming. And I can't give you the day, I can't give you the time, but I can tell you it is exciting. And those that know, those that are in the rare earth business, know we're on the right path. And I believe a number in the rare earth business are envious of our ability to be able to treat monazite at an existing permitted facility right now.
And what can Energy Fuels shareholders expect in terms of news flow here in the coming months?
Well, news flow will be on the uranium front, on the rare earth front. I really want to show the market as soon as possible that we're securing substantial material feeds of monazite from very significant partners. And I believe that will connect the dots when it comes to, if you have the elements that can go into our processing facility, people will get it, that it is going to happen. So, you know, those are the key fronts, is as we unfold the uranium business with these increases, hopefully in uranium prices, securing the monazite feed, and also more guidance on the building out of full integration separation at White Mesa, and perhaps other steps in the integration supply chain in the metals and alloys area. So it's going to be a very exciting time, and it is our goal. I don't come with a warranty, but it is our goal to become a multi-billion-dollar company with significant positive cash flows with margins that I believe will be very attractive to our current investors and future investors.
That's a great close, and thank you for sharing the Energy Fuels story with us today, Mark. And to all of our viewers, if you have any further questions for Mark and his team, please send us an email to info@bloorstreetcapital.com. Or if you would like some research on Energy Fuels, send us an email and we'll send it along. Once again, Mark, thank you.
Thank you.
Hi, Roger. Thank you for joining us today. How are things in Saskatoon?
They're doing all right here. We're getting the start of winter, which is good. And we like to see it get a little cold here so we can do our winter program. So cold weather is a good thing.
Roger, let's start with a brief overview of UEX, and then we'll look at your various assets in more detail.
Okay. Well, UEX is a unique company in the uranium space, particularly in the Athabasca Basin. We're not a single trick pony, as I like to call it, with one particular project that you can poke at and go, that's UEX. We're a portfolio of opportunities ranging from development-ready projects and development-ready projects through to grassroots projects. And probably the great value driver for us is those mid-stage resource level projects where we have advanced exploration opportunities that are lower risk exploration. So we're a portfolio of opportunities, not just a single opportunity. And it makes our story a little harder to understand for many investors.
Well, we're going to work on that and break it down into a simplified form so people can understand it. So as you mentioned, you have a portfolio of 31 assets. We don't want to spend the entire time looking at those, but I do want to spend some time focusing on your more significant assets, of which there are 4, and they're the most advanced ones. So let's begin with Horseshoe Raven. UEX owns 100% of this asset. It's situated in the eastern end of the Athabasca Basin, and which is also close to where Cameco operates. Why don't you just start with a brief overview of Horseshoe Raven?
So Horseshoe Raven's on the east margin of the Athabasca Basin. It's 4 kilometers from the very first discovery ever made in the Athabasca Basin, the Rabbit Lake deposit that is now owned by Cameco and has been mined out. The deposits were found actually in the 1970s. From a compared to the Athabasca grade and tonnage point of view, it doesn't look that sexy because you don't see those super high grades. But you put this project anywhere else in the world, it'd probably already be mined out. Particularly today, if we plunk this in Wyoming or somewhere else, so people go, oh, low grade, and yeah, it's a 0.2% U3O8 deposit, still higher than world average standard. The advantage it has is what it can do cash flow wise, or what our old PEA had cash, when we did our PEA cash flow wise. We think it's profitable on a pound for pound basis as most things out there. And it's because we don't have the water issues you see in a lot of the Athabasca projects. We don't have the higher grades, so we don't need the same radiation protection measures as we move forward. It's relatively simple metallurgy. So we think this is a project that will move forward as when the market calls for more pounds, and we think it's relatively easy compared to many of the other projects out there, and just as profitable, just not as big.
And the other point we should highlight, because it is in the eastern end of the basin, it's also close to infrastructure.
Yeah, actually, we have nuisance infrastructure in the way. We actually would have to move the access road to Rabbit Lake and divert it around the operation, as well as the power line. So you don't get much better than that when it comes to infrastructure.
And Roger, is there a resource on this project?
Yes, there is a resource on the project. It has just about 37 million pounds combined indicated and inferred resources, and an average grade of about 0.29 or 1.29% U3O8. So yes, not your MacArthur grades and not your MacArthur size, but a pretty, if we were to compare that to, say, a US ISR producer, that's pretty nice grades, and cost-wise, it would probably be very favorable.
And Roger, you also touched on the fact that water is an issue within the basin. Can you just expand on that and tell us what you mean exactly?
Well, the Athabasca Basin deposits occur in the bottom of what I call, it's the equivalent of a bathtub filled with sand. And the deposits form at the cracks in this old bathtub at the base. Sometimes they're at the interface of the sand in the bathtub itself, or in the bathtub crack itself. But that sand is saturated. And so depending on the amount of sandstone and how much the rocks are cracked up in the sandstone, you can get a lot of water inflow, as we saw at some of the historical work done happened at Cigar Lake and MacArthur River in the past. When you're off the edge of the basin, you don't have that saturated sand cover over you, so you don't have the same issues with water. It's more like conventional mining you'd see anywhere else in Canada.
So let's move on. Another asset I want to discuss is Hidden Bay. That's also in the eastern portion of the basin. And it's also unique in the sense that it borders on 2 world-class operating mines, Orano's McLean Lake and also Rabbit Lake. Can you give us some background on Hidden Bay, please?
So Hidden Bay was one of the very first exploration projects in the Athabasca Basin, going back to the early days of exploration. And it's been extensively explored. There's 1,800 drill holes on it, and you go, oh wow, this is an old project, and yes, it is. But the bulk of that work was done back in using old school methods, looking for the classic MacArthur Cigar Lake deposit. And so they would drill to the unconformity and they would stop. In fact, when I joined Cameco in 2001 as an exploration geologist, my boss told me, don't drill more than 25 meters below the unconformity because you're wasting your time. And meanwhile, he was standing in front of a long section of Cameco's Eagle Point mine, which goes 500 meters below the unconformity, and it's a world-class deposit, and it's right there. So this, what we like about Hidden Bay is its basement potential for an Eagle Point, a Millennium, or an Arrow type deposit. And every one of those deposits has an expression at the unconformity. It's a little bit of smoke, per se. So smoke always leads to fire, and that's kind of, we see lots of spots where there was smoke identified, even mineralization that didn't come up to the unconformity but never traced down where you'd find an Eagle Point, a Millennium, or an Arrow. So what we have at Hidden Bay is a huge database that of drill core and historical observations that allow us to find the smoky areas. We've got about a dozen of them on that Hidden Bay property, and the focus wouldn't be for a hurricane type deposit or a cigar-like deposit, it'd be for an Eagle Point type deposit. And so we're already miles ahead of where a lot of our peer companies would be looking for grassroots exploration projects where they're going, oh, we have this trend, we wonder if it's productive. We can go, oh, it's productive, and our trend is productive over this 300 or 400 meter area. And so we know where to look down dip. And I think that gives us a tremendous advantage for new discovery, and yet very, very shallow, because we're talking about 0 to 200 meters and generally less than 50 meters of sandstone cover. So basement hosted deposits that are very shallow potential.
Roger, you mentioned basement deposit a couple of times, and I'm not a geologist. Can you just explain that? What's the significance of a basement deposit?
Well, basement deposits are below that sand interface. And so there's two distinct advantages when it comes from a mining and mining engineering point of view. And one is you're away from the sand and that saturated sand cover. So you generally have less risk of water inflow. And then you can use a little more conventional mining techniques that maybe don't require the fancy freezing techniques that we're seeing used in some of these other locations. So while those deposits are really fantastic, they're an order of magnitude higher grade. They also come at an order of magnitude higher cost to produce. So we look at it from a, what do you get on a cost per pound basis? And I think if you look at some of the stuff that's out there in the PEA, in the Athabasca Basin, those basement deposits are very economically attractive.
UEX owns 64% of Christie Lake, which is situated in between MacArthur River and Cigar Lake. Can you provide some background on this asset, please?
Sure. This property was owned by JCU, which we just actually recently bought 50% of. JCU is a Japanese consortium of companies, privately owned, and they've been very active in the space in Canada for many, many, many years, 20 odd years until we bought them out here recently. They owned, through staking back in the 80s, the extension of the MacArthur River fault structure called the P2 corridor. And that P2 corridor continued onto their property where they made a deposit discovery called Paul Bay. And so that trend, while you think it had been explored really intensely, had not been explored very intensely. When we were able to option a property back in 2015, early 2016, and add to the resources there by finding other deposits. But the trend, we focus on a very small area of that property, the trend back towards MacArthur River is still essentially unexplored. Where we have put a couple holes and only a couple, we're getting encouraging results. So we think, a lot of these deposits in the basin form like in clusters that resemble pearls along a string. So we've got a couple pearls, but the string is, the string continues all the way back for another 9 kilometers to MacArthur River, and that has been unexplored. So we're thinking we'd like to do more work there to find more pearls along that string.
Another project I want to discuss is Shade Creek, and that's different from the previous 3 that we discussed in that it's in the western end of the basin. And UEX owns 49% of this, Orano owns the balance, and Orano is also the operator. Can you give us some background on this asset, please?
Well, it was certainly back in the last uranium cycle upswing, this was the darling of the market. First of the ever highest grade reported high grade deposit intersections in the junior sector, that 20% over multi-meter type intersections. And UEX was the first to do those things through our partner Orano. It's a great property. It's right next door along trend of what was Cleft Lake Mine. We love the property because we once again, pearls on a string. We have 4 pearls, but the funny part about this deposit is it's been explored like it was looking for a cigar-like type of deposit at the unconformity. Yet half the resource we know is in the basement in high-grade intersecting faults. And every one of these high-grade deposits in the Athabasca Basin, without exception, occurs where a cross-cutting fault hits the main trend of fault. And that area where they intersect creates a little bit of blowout area. We see it in the gold sector in the Abitibi, the same kind of structures. And half the resource is in the Arcana deposit. And the funny part is it blows out along that secondary structure. We've identified 10 areas underneath the existing mineralization where the poles have drilled and actually intersected that structure, but not consistently. And it's because of the orientation of the drill hole. So if you're trying to hit a vertical body, the secondary structure with the vertical holes, really hard to do. You'll hit it once in a while, but not every time. Very hard to do. So they need to come in and drill holes from the side. And we've identified 10 of those areas, and we think we can grow the resource there substantially. The challenge has been our partner Rano has been through a few restructurings over the last couple of years, and they're still trying to figure out where they're going with things. We've been encouraging them and working with them to try to find a way to get project working here again. We think for many reasons. One is what's happening elsewhere in the southwest side of the Athabasca Basin, and we think Shea Creek's probably the #1 brownfields exploration project in the entire Athabasca Basin. We just want to see it get working again.
So I was going to ask you, of the 4 projects we discussed, Horseshoe, Hidden Bay, Christie Lake, and also Shea Creek, which one has the most blue sky? It sounds like it's Shea Creek.
And then I think you can have even within our own team, we would have a debate about whether it's Christie Lake or Hidden Bay. Horseshoe Raven, I think, is a project that we're ready to do some more heap leach studies on and move it forward to the next engineering stage. And that's something we'll do when the market signals that's ready for that. But we think those are the 3 projects that we own, we have control over, major direct ownership of, that we like the most. I mean, we certainly have a new bunch of projects we got from JCU as well, including 3 mine development ready projects, Wheeler River, Millennium, and Kigavik, that will help us move forward. The advantage we have for our investors is that we don't operate those projects, and so we can devote our resources to finding more pounds through more discoveries, as opposed to trying to put all our energies into to get the next mine up and running. We'll get that benefit, but as sort of the quiet partner.
So let's talk about exploration now. You did have a summer program. Why don't you just provide us with an overview of that program?
So we had a small program. It was much smaller than we wanted it to be. Had a lot to do with contractor availability, which sounds really strange because there wasn't a lot of work done in the Athabasca Basin last year, but a lot of resources were tied up elsewhere in the country through gold exploration, strangely enough. And we couldn't get a drill rig until September when we wanted to start in July. So anyways, we get to do a modest program along the trend of the Christie Lake mineralized trend. We call it the Yellowega trend, towards the northeast property boundary, where we had some good indications last year. We're just putting up we finished that program. We're just interpreting the results here. We need some laboratory work back as well. And those will be out hopefully relatively soon into the market. But that's only we believe we've only explored about 10% of the trend. Now, we're looking at next year focusing on other parts of the trend as well that have seen very little exploration.
And do you have a winter drilling campaign lined up?
Oh yeah, I think for us, we're looking at a more aggressive program over the last couple of years. Or compared to the last couple of years, we've been very conscious about trying to minimize dilution, despite the fact we just made a big raise to buy JCU, we used to buy JCU. We've been very conscious about sort of right sizing what we do compared to where the market goes. Now the market's a lot more interesting. Our shareholders are demanding a lot more work, and we certainly have way more targets than we can possibly spend even in the most robust uranium markets. So we're going to see a bigger increase with work at Christie Lake. We'll probably be doing some work on our other project at Hidden Bay to follow up encouraging results from last winter's program, just north of the Raven and Horseshoe deposit, and a couple other our target areas we identified for basement potential as well.
So what's your budget going to be for the winter campaign, and also how many rigs will you employ?
I can't put that out because we haven't put it out in the news release yet, but substantially more for sure. We did a $2.5-ish million worth of work last year. We were looking at doing substantially more than that this year.
So let's move on to your balance sheet. You just mentioned that you did a raise recently. Why don't you tell us about that raise and what the proceeds were for?
So in early September, we raised $21 million. That $21 million was to buy our interest in JCU. We own 50% of JCU. JCU has historical resources of about 96 million pounds. We bought essentially the historical equivalent of half of that at an average cost of 41 cents a pound, which was a great deal then. It's an even better deal now that uranium markets are moving much quicker. I think we did that deal and set that price when the uranium prices were, what was that? In early August, we were still down in that low $28 to $32 range. So we've done pretty good with that. That's almost all the proceeds went into making that, all the proceeds went into making that payment to make that purchase. So it was a substantial raise, but it was also for a substantial amount of assets. 3 mine development projects. We added an interest in 3 of them to our portfolio.
And you bought half of the JCU interest. Who bought the other half?
Denison bought the other half. We had a deal to own all of it at one point in time. Denison came in because they were interested as well, because one of the key projects in JCU was a 10% stake in the Wheeler River project, which a lot of people have heard about. And they're doing Denison operates the other 90%, owns and operates the property. They own 90% directly. And it's their flagship project, and there's really good work being done there. And they wanted to increase their interest. We came to an agreement to split the company in 50-50.
And Roger, what's your cash position right now?
We have just about $5 million in our treasury, not including money that we inherited along the lines from JCU as well, that we manage on behalf of Denison and Denison and UX, which is just about the same. So our JCU, what we're expecting to do in JCU is well covered through the end of next year. And then directly, we're reasonably well covered until into next year. Our G&A is really well covered. And we might want to, depending how much we want to do, we might want to consider adding to the treasury for that reason, but we don't need to.
Roger, as we already discussed, you do have 31 different projects in your asset portfolio, and we touched on some of the more significant ones. Would you ever consider selling off some of those assets which you consider to be non-core, or spin them off just to raise cash, or maybe help you realign your focus on what's important?
Oh, absolutely. And it's always been about the right timing. So for us, it's a question of, you could do a deal at any time, right? The question is, what's its valuation? Sometimes it's better to hold something for a little while to see it change. I think in the uranium market, a deal last year will look very different than a deal this year, based on where things are going. We've also, like to see more of the projects working, because we have this vast portfolio. The question is about getting the right valuation for UX shareholders and bringing in a partner that had the ability to finance their share, whether it's work or an acquisition. And I think until very recently, over the last decade, that's been a very challenging proposition. Of course, there are incumbents in the space. We all have our favorite projects, and we're all here for a reason. So to sit there and say we could talk to company X that's been around for 10 years, sure, we could have. Would we have got the maximum value out of it? Probably not, because they have their favorite project that they're looking at. And saying that we want to finance that when the market changes as well. They didn't want to be committed. And we did the same thing when people came to us as well. Adding our 32nd best project to our portfolio is not value creating. So I think the market now has a lot more momentum, a lot more investor interest. There's the ability to do deals that there's a win-win on both sides.
Roger, is there anything about UEX that you feel the market doesn't understand and you would like to communicate to the market?
Yeah, it is a complex story, because it's not that single shiny object you can point at and go, hey, that's what their value is. And I think if you asked many investors have a different view of what the best part of the value proposition of UEX is. What I like about our company is that, well, you get exposure to the resources, and you get exposure to mine development through our 3 mine development ready and development ready projects. You have a grassroots portfolio that can be monetized. Where we are really strong is in what we call our mid-stage and resource level projects. These are projects like Christie Lake and Hidden Bay, where we got probably our investors have a lower exposure to do discovery potential because of the portfolio. They're not just hey, we got an area of Moose Pass, let's see if we got something. It's, hey, we got a problem to solve. Did this mineralization go somewhere? So we give our exposure of our investors to that growth opportunity, and that new discovery, no matter what cycle you are in the uranium markets, that discovery potential, or realizing that discovery potential, the value that creates to shareholders is always better than any production company, development company, or grassroots company. I think you have a little bit of safety in your exposure to pounds, market-ready development, but you have that growth potential. It's probably unparalleled. It's a portfolio that a lot of our peers would love to have.
Roger, as we wrap up, what can investors expect in terms of news flow in the coming weeks and months from UEX?
So there's sort of 4 key things you're going to see going forward. A wrap up of Christie Lake results from this fall's program is still outstanding. You're going to see updates on the Wheeler River feasibility study that we own through JCU, and that's just started a month ago. We are going to be announcing our plans for the upcoming winter drill programs that we talked about doing a little more work on, and also looking at the opportunity to see valuation for our cobalt assets, which the market and investor interest in cobalt is starting to come back to levels we saw back in 2016, 2017.
Roger, thank you very much for sharing the UEX story with us today. And to all the viewers, if you have any further questions for Roger and his team, please send us an email to info@bloorstreetcapital.com and we'll get you an answer. Or if you would like some research on UEX, send us an email and we'll send it along. Once again, Roger, thank you.
Thanks for having us. Looking forward to talking again in the future.
Hi, John. Thank you very much for joining us today.
Great to be back.
John, there's been a lot of new developments at Sprott since the last time we spoke, including your AUM going over 20 billion, further growth in the Sprott Physical Uranium Trust, and also your recent acquisition of the North Shore Global Uranium Mining Index ETF. And I want to talk about all those things. But before we do that, just for the benefit of those who might not be familiar with the Sprott name, can you just give us a bit of background on Sprott and tell us about your various divisions and your mandates in those divisions?
Yeah, sure. So Sprott's been around since 1981, so it's a long-standing Toronto-based company. But you know, the firm has evolved greatly over the years, and most of our clients are actually in the United States right now. We manage money for everybody from institutions right down to individual investors. And our focus is really on metals and mining and real assets. So we run a number of physical commodity funds that hold physical gold, silver, platinum, palladium. More recently, the Uranium Trust, which owns physical uranium. And then we have a business that manages public equities. Those are mostly in gold and silver mining. And then we also have a division that invests in private investments. And those are very interesting in the mining sector, related to private debt, streaming and royalty deals. And then finally, we have a broker-dealer in both Canada and in the US that focuses on both the institutional market and the retail market. And I'd say 2021 has been a real watershed year for us in terms of all the divisions really performing well. As you mentioned, we recently broke through the 20 billion US AUM level, which is the highest the company has ever reached. And I think that's just a reflection that a lot of the different investment themes that we focus on have worked out really well, and there's growing interest in them globally.
That's a great overview. So let's move on to the Sprott Physical Uranium Trust product, or what is quite often referred to as SPUT. In July, when you took over the UPS product, the NAV was around 600 million. At the end of October, it was 1.6 billion, and now we're into November. Has that number increased since the end of October?
Yeah, it has. We are very close to 2 billion. So I'm hoping we're gonna break through that number any day now, but we're just shy of $2 billion. So I think we spoke about 4 weeks ago, and I just did a quick tally and concluded that since we spoke, we've added another 6.6 million pounds of physical uranium over that time. So The interest that we're seeing globally continues. When we acquired UPC back in July, we had 18.1 million pounds of U3O8, and we're very close to 40 million pounds. We're about 700,000 pounds short as of recording today. So we're almost at a very big milestone of 4.0. So it's been incredible. I'd say the very interesting thing that's happened in the last 2 months with the trust is that the interest we're seeing in it has really evolved to more generalist investors and more global investors. Many large institutions around the world that have different fund mandates, whether they're equity mandates or macro funds or clean tech funds for that matter, are now looking at uranium as a potential investment. They like the theme of decarbonization. They view it as an ESG centric investment. They look at it as still a value type of play, even though the price of uranium's gone up about 50% in the last 3 months. It's still way, way below where it was pre-Fukushima, and obviously in the last cycle back in 07, where it hit almost $140 a pound.
And the size of the product or the growth in the product really must help that too, bringing in these new investors. As we mentioned earlier, when you first purchased UPS, it was only 600 million in AUM or in NAV, so it was relatively small. But now, given the growth in size, it must make it a lot more beneficial for institutions to buy this product.
Yeah, and that's a really good point. I mean, when we acquired the predecessor vehicle, I made it very clear to everybody I thought it was way too small because it didn't have the size and scale to really entice institutions to get interested in physical uranium. So, you know, at 630 million, if you're an institution and wants to come in and purchase $50 million of the fund, you know, you sit there and you say, am I comfortable being that percentage of the fund? Do I have any restrictions on that? Now, fast forward to today, the fund is almost $2 billion US. You're having very different conversations in terms of the dollar amounts that the fund can take in on any given day. And we've had institutions in the last 4 to 6 weeks come in with, you know, $30 to $50 million single trades that we've done with them, and you know that we can accommodate very easily now as the fund is scaled up. So it is a very important point to get bigger institutions and more institutions involved.
And John, the ATM in its current form, I believe the maximum or the cap was 1.3 billion. You must be coming close to that.
Yes, we are. I think the current number we have remaining is somewhere around 275 million. And it's been pretty astonishing because when we filed the second shelf prospectus back in September and added $1 billion to the number, we obviously caught the market's attention with a pretty big number, and it's amazing that we've almost drawn down most of it in the last 2 months. So that's something we will review and you know, add to as if we see more demand.
And the mechanics behind doing that or increasing that number, it's relatively easy, is it not?
Yeah, I mean, it is a process you go through with the regulator. We've done it for other trusts multiple times, so it's something we'll strongly consider for sure.
And what's the maximum allowable cash position of the trust, and how soon after you raise cash, how soon do you have to buy uranium?
Yeah, so the trust documents basically say that the fund should try to be at least 90% invested at all times. We have a little bit of flexibility around that. We've been running at about 97 to 98% invested at all times. So we've run that well below the threshold of 90. We have been holding a little bit more cash of late. We want to have a little bit more dry powder to take advantage of any market dislocations that we've seen. And we did see one back a few weeks ago where we saw a little bit of a lull in the market. There was a little bit of overhang of supply, and you know, we wanted to take advantage of those lower prices. So we're holding a little bit more cash, but as I said, it's still, you know, in the kind of 3% of AUM, and that's worked out pretty well of late.
And what's the latest news with regard to your U.S. listing?
Yeah, so we started that process with the New York Stock Exchange. They're starting to draft the application documents, and they've just sent us a first draft to review. So that's one of my tasks this week with my team, is to review that, and that we hope to have that application submitted before the end of this year.
That would be a nice way to finish up the year.
Well, that was the promise we made to the UPC shareholders, that we would get the application in within 6 months of the transaction, and also Sprott is also paying for the legal costs related to that. So that was the last phase of our enhancement program, as we describe it internally, to reorganize UPC.
So that's a great overview of Sprott. Let's move on to North Shore now. You recently announced the acquisition of the licensing rights to North Shore Global. Do you just want to provide an overview of that? And I guess also tell us what was the impetus behind doing so?
Sure. So, in the last few months, as we've been marketing the Physical Uranium Trust to investors around the world, it became very apparent to us that many investors, whether they're retail or institutional, are co-investing in both the equities and the physical. And every investor is a little different in terms of risk tolerance and valuation sensitivity and so on. But a lot of investors are holding the equities, uranium equities, and the physical in some combination. So it really dawned on us to say, well, look, we're having this great impact with Sprott in the uranium, on the physical uranium side. Why wouldn't we have a uranium equity side, just like we do in our other segments? So, for example, we have a physical gold trust, and we also have a gold miners fund. So it's the same principle of having both solutions available to investors around the world. And the North Shore Fund is about 2 years old. It obviously started at a very low point in the uranium cycle. It really kind of meandered around $20 or $30 million of assets for the first year or so, and then it took off. And right now the fund is $1 billion. So it's a very significant size fund. We think it's the best pure play uranium mining ETF in the world. Tim Rotolo, who's the kind of key architect and sponsor of the fund, he acknowledged that putting his uranium ETF and Sprott together would be the perfect combination for the marketplace. And we finally reached an agreement to do that. So over the coming months, we'll be getting all the necessary approvals, and then hopefully the new Sprott uranium miners ETF will be born sometime in Q1 of next year.
And do you plan on making any changes to the ETF, or is it just going to continue on in its present form?
No, our playbook on these acquisitions is really simple. It's about continuity and making improvements where we can. So we really like the underlying index and what Tim has done, and we're not really planning on making any material changes to the current structure.
And you mentioned earlier that you have managed funds focused on gold and silver. Would you ever start a fund focused just on uranium stocks in addition to this ETF?
Well, this ETF will be focused on uranium equities. So the miners, the developers, the explorers, it holds kind of a cross section of uranium equities. So that's the primary mandate of the North Shore Index.
Yeah, but that's going to be passive. I guess the question I meant to ask was, would you ever start an active?
Okay, got it. Nothing planned at this point. I think ETFs are really one of the most popular choices for all investor segments today, and it's really where all the money is going. And that's because they're wonderful vehicles. I mean, they're transparent, they're liquid, you can trade all day. People love the transparency of the daily disclosure of holdings and the methodology. So we really like the ETF vehicles, and it was one of the reasons why we pursued this one.
So let's move on to the uranium market now, and I want to pick your brain a little bit about this. And one of the things that surprises me that in spite of all the activity that we've seen from Sprott and also your competitors, and also this tidal wave of sentiment toward this green economy, also China announcing that they're going to build 150 reactors over the next 15 years, just a lot of positive news, but yet the price seems to be hanging around the mid 40s. And I'm surprised it's not a lot higher. And it seems like there's always an ongoing supply of uranium coming to the market. Can you give us a little bit of color on that? And what are you seeing?
Yeah, sure. Well, first of all, I'd like to point out the price of uranium is up about 50% in 3 months. So I don't want to downplay the move it's had. It's had a pretty significant move. And if you take a step back and look at the longer term chart, the price obviously meandered in the 20s and 30s for a very long time. So when the price of uranium broke 35, that was to us the first kind of significant psychological or technical barrier. And the reason was we just hadn't seen a price for about 5 years at 35. And then we kind of broke 40 and 45, and we did touch 50 very briefly. So there, I think the category has demonstrated that it can move when there's interest. So we think longer term, the price is going to get to the incentive price needed to get a lot of supply back to the marketplace. And every company and every mine is different, but clearly the days of uranium with 2s or 3s or 4s on the starting price are kind of moving behind us now. And we think that longer term, there's a very constructive story behind getting uranium prices to much higher levels. So that's really what we expect to happen. It's not going to be an overnight move. What's really going to move it in the next few innings, we think, are going to be the utilities. The utilities coming to market, reloading their contracts, and that's really what what's going to drive the next leg of what we believe is the early stages of this bull market.
And John, I know you can't tell us exactly who the sellers are, but can you give us some color in terms of, are they producers, or are they other financial players? Who exactly are they?
Yeah, well, I think we've purchased uranium from close to 20 different parties. So it's and I think that's a function of, one, the volume that the trust has been buying, and I think it's also a function of the price is finally back to levels that haven't been seen for a very long time. And I think people can't lose sight of this perspective that the price of uranium has recently been reached levels that hasn't been seen in 9 years. When that happens, that changes people's behavior in terms of, okay, I can finally sell this stuff that I've been sitting on for a very long time. It actually loosens pounds and sets them free into the marketplace. So we've seen some parties come to us and say, hey, we've got some pounds to sell you, and we've got pretty good intel that a lot of those pounds were purchased years and years ago. So this price discovery that's happening and this new liquidity and activity that's happening in the spot market is acting as an incentive to basically loosen those pounds and put them into the marketplace. And the trust has done a pretty good job of acquiring them. So everybody has an incentive price, whether you're a trader or a producer or a financial holder or a speculator, in terms of where you want to sell your pounds and what kind of profit you just made on them. So yeah, I think the reality is there's always pounds coming into the market. I think at some point we're going to find that we might have more trouble finding pounds as a lot of those earlier sequestered pounds kind of come loose and we acquire them. It may be harder for us to find fresh new pounds.
And John, on your Q3 call, you mentioned, or I believe somebody asked a question about whether or not you're looking at other metals. Can you provide any insights on that or any updates?
Yeah, I mean,
just in terms of other investment funds.
Sure. Yeah, I mean, we're constantly looking at the market landscape and the market dynamics and trying to figure out what we think might make sense in terms of different investment ideas. When we launch new funds, we have to take a pretty hard look at them and ask ourselves, one, would we put our own money in that? Because essentially we do seed a lot of our own funds. So whether it's an acquisition or putting seed capital into a new fund, it's not a light decision to write a check for, say, $10 million of our own capital. So I think that's always our first test. Do we eat our own cooking? And second of all, can you structure something that is marketable and is shareholder friendly? Those are really critical decisions for us, because there's no point in providing the marketplace with more Me Too products that don't really differentiate themselves or add real value relative to what's available. So there is a very interesting shift going on right now in a number of sectors in the metal sector, which has us looking at different areas. We haven't made any final decisions, but a lot of these sectors have gone through 10-year bear markets. And over those periods of time, it's very difficult to launch new funds into that kind of inertia. So with metal markets coming back to life, I think that gives us good opportunity to review some of these different segments and see if there's a good fit.
John, I want to digress now away from uranium and ask you about something that you and your team know intimately, and that's gold. Mm-hmm. Every commodity and asset in the world is up significantly. Oil's up over 100%, Bitcoin's up over 100%, uranium's up over 50%, gold's flat on the year. Is gold ever going to catch a bid again?
Yeah, well, gold is definitely starting to come out of its slumber. You know, some people might have said, well, gold is dead, and I think the right response is gold is just basically dormant right now. It's been treading water. You know, gold did its job remarkably well in 2020 when the world was looking for safe haven and all the disruption related to COVID. So gold was really the star in 2020, and it's, as other things have recovered, and central banks and governments have pumped trillions of dollars of liquidity in the system. That's obviously incented a lot of risk-on buying activity, hence why a lot of things like metals and energy products have caught the bid. But we think that gold is going to start to respond more productively. I think one of the things people are starting to realize is this inflation is not transitory. And you know, a lot of people think gold is an inflation type of asset, and the reality is gold does really well when inflation is quite high. And we're starting to get to that point where the prints on these inflation numbers are starting to become more meaningful. So we saw that in the last couple of weeks where gold perked up when we printed that 6% inflation number. People are starting to realize that this inflation trend may not be short-lived, and I think gold will perform very well with that backdrop. And you know, everything has worked so well for so many different asset classes. All you need is a little bit of a black swan or a little bit of a scare somewhere, and it's amazing how people's risk appetites and change and you know, capital can move very quickly.
John, as we wrap up, what can investors of Sprott expect in terms of news flow in the coming months?
Yeah, well, I think you know, we're working on some new product ideas. The acquisition of URNM, I think, is going to be a really great complement to Sprott. And you know, we're constantly looking to improve our business, and I think we're in a really good sweet spot right now. We've got a lot of tailwinds right now in our business, and I think Sprott has raised a lot of awareness of our organization in terms of people have always known us for precious metals and mining. Adding in an adjacent strategy, I think, has been very well received, and it's also, I think, helping Sprott Inc. share price recently hit a new 52-week high.
John, thank you very much for spending time with us today and providing us with updates on the various Sprott products. To all of the viewers, if you have any further questions for John and his team, please send us an email to info@bloorstreetcapital.com and we'll get you an answer. Or if you would like some research on Sprott, send us an email and we'll send it along. John, once again, thank you.
Thanks for having me. Appreciate it.
Hi, Grant, and thank you for joining us today.
Yeah, hi, Jimmy. It's a pleasure to be here. Thank you.
Grant, I want to provide a framework on where I want to take our discussion, and I want to begin with a macro view, a top-down look at the spot and the term markets, followed by a discussion on Cameco and your various operations. And before we get into that, the Nuclear Energy Institute recently held a conference in Savannah, Georgia, and it's one of the main conferences for the nuclear industry. And you had the opportunity to attend. And one of the great things about going to a conference is that you meet people face to face and you can gather a lot of information. And I'm just kind of curious what people were saying at the conference. Were people talking about what's happening in the spot market and the term market?
Yeah, certainly it was a conference. First time we had all been together in almost 2 years, face to face. This conference generally attracts US utilities. It's not the global conference, but that's a pretty important customer group. So it really does set the tone. And one of the great observations for us is that the tone has improved. We've gone through a lot of really rough highway in the front end of the nuclear industry. Prices terribly low. You know, you've seen a lot of folks struggling to get by in that market. But now we're seeing a strengthening tone. It seems to be recognized both on the supply side and the demand side. I would say our customers largely understand the days of buying uranium that starts with a 2 are probably over. The days of buying uranium that starts with a 3 are probably over. And I think the question is, how much can they buy that starts with a 4 before they have to pay even more for it? And that's because that's where the fundamentals are. You know, we're a funny industry right now. There's very little debate that the demand picture is strengthening, and it's strengthening in a durable way that we haven't seen for quite some time. And yet productive capacity, if you extrapolate it forward, is not keeping up. And so we're now sort of catching that fundamental reality, and that's what's being reflected in price strengthening.
And Grant, nuclear power provides approximately 20% of electricity generation in the U.S. And because it's only 20%, do U.S. utilities care about the recent move in the uranium price, or are they more concerned with the move in nat gas and coal?
Well, I mean, I think it would be inaccurate to say they don't care about their costs and whether those costs are a big driver of their operating and maintenance budget or a small. Like everybody else, every penny counts. But the reality in our business is that our customers have been price sensitive largely because the supply side has let them be. You know, the typical reactor is focused on security of supply. Utilities don't buy in the spot market for their run rate requirements. They buy that in the term market, and they cover it for many years at a time. The only reason that they've been price sensitive is because we've seen some stubborn production that had no home because it was improperly timed for a market cycle, show up with no place to go, no term demand post Fukushima, and it got dumped into the spot market. And that's really what afforded the fuel buyers the opportunity to be price sensitive. But in a normal world, it's more important that the fuel bundle is there to power the reactor, because if you brought a reactor down because you were quarreling over pennies and dimes, maybe quarters on the price of uranium, that's a significant career limiting move for our customers. And so, you know, hopefully we've entered a situation now where the supply side has collectively understood that making material available in the spot market is no way to create value. And there are utilities that are willing to pay production economics for uranium if we just let them.
So that's a great overview of the conference. Thank you. And let's move on and touch on the spot market and what's been happening there. You just talked about uncommitted primary production and how that's distorting the spot market. Can you give us your views on what's been happening in the spot market in the last few months?
Yeah, and if it's okay, Jimmy, I might actually stretch it back a little bit longer, because I think understanding where we've been is pretty important to understand where we're going. Right now, there's a lot of focus on the spot market, new investors to the space. There's a lot of trade press. There's a lot of broader general press on what's going on in the spot market. And it's a bit of a head scratcher when you think it's not the fundamental market in the uranium space. So why is there so much attention on the spot? Well, that's the problem that needed to be solved. We came out of a nuclear event, and that, of course, was the Fukushima event. And we went into one of those classic divergence moments. Demand was falling away, utilities shutting down reactors like in Japan, building new regulatory frameworks. A lot of reactor capacity was idled. Countries that were on a path decided to abandon it. Germany would be a good example there. And while demand was reacting downward to Fukushima, a lot of supply that had been incented prior to Fukushima continued with an investment and then ended up as production, and all this shiny new production showed up, and there wasn't a contracting cycle going on. And that's what I talked about earlier, that it ended up in the spot market. So normally the spot market is a small discretionary market. Utilities really only use it to shore up their inventory position or to buy a reload during a fuel outage, planned well in advance, of course. And that's going to be true whether the world is consuming 180 million pounds of uranium or 300 million pounds of uranium on an annual basis. Utilities will not use that as the fundamental market. But when this productive capacity showed up and it had no home in a term contract, it ended up in the spot. And then our story took a turn. You know, the oversupplied spot broke the price signaling. The term price, which was supposed to reflect production economics, actually became nothing more than the forward price of buying in the spot and carrying it. And utilities said to themselves, hey, as long as suppliers are going to continue to put primary production in the spot market, I'm not going into the term market. I'm just going to find a financial who's willing to buy in spot and carry it forward in a low interest rate environment. And we had the creation of the carry trade. And the carry trade started to rob term demand. And as it robbed term demand, we saw levels of term contracting go down further and further, and we saw the collapse of the term price away from production economics. So the spot market has taken on this outsized role because it needed to be cleaned up. Cameco's entire strategy in the last number of years has been to contribute to the cleanup of the market. We're not an offender. We don't sell our production into the spot market. But sitting around and waiting for others to do the right thing wasn't a good strategy. So what we embarked on was a very aggressive supply discipline strategy. And we took down some of our assets, starting with Rabbit Lake and then our US assets. And that wasn't enough. So then we curtailed McArthur River, and we curtailed it well below our committed sales, our term contract homes, because that was the only way we could have an impact on the spot market. We became the largest buyer in the spot market. And so as the spot market was cleaned up, it then paved the way for what we're seeing now. You know, a smart physical fund manager who knows commodities and has played in the space in other metals realized the opportunity was now. The big heavy lifting had happened, and they could come in and harness investor interest, deploy it specifically in the spot market, prove that it really truly is a thinly traded market. It's had a significant impact on the spot price, and now we're starting to see the fruits of that, with the reflection being in the term price as utilities are going, okay, the days of buying spot material and carrying it into the term market are probably over. We're in a slightly backwarded market, so the most expensive pounds they're going to buy actually are the carry trade pounds right now. And so the conversations are returning to, what does a term contract like need to be? So spot price is up, and now term price is up about $10 on average. This is the direction we needed to see. We needed to take the spot market from being the problem and turn it into part of the solution. And that's what we're seeing with the emergence of the physical funds, and in particular, the Sprott Physical Uranium Trust.
So overall, the spot market has become a lot more efficient because of your actions and also actions of others.
No question. We're seeing a degree of transparency and a degree of liquidity in the spot market that we're not accustomed to in this industry. You know, our industry has a price reporting mechanism, not a price discovery mechanism. We don't have the volume or the frequency to truly discover a price. And price reporting involves a lot of judgment. And a lot of judgment means that there's a lot of opinion in it. And then along comes actors like us buying at the front end of the spot market, like the Sprott vehicle buying at the front end of the spot market, posting actual transactions that you don't have to debate or apply any judgment on what the price really is. There's a degree of transparency and liquidity and now price discovery that we haven't seen before. It's a good thing for the industry.
So that's a great overview of the spot market. Let's move on and discuss the term market. And I'm hoping you can give us some color in how many RFPs are in the market right now, and maybe what countries are involved in the market right now.
Yeah, great question. That is how value truly gets created in the uranium space, by participating in a contracting cycle, by building homes for productive capacity, and then designing your production plans to go into those homes and stay off the spot market. And so it is great to see the term market start to pick up. It had begun to show some life since we started our strategy back in 2016. We've layered on another 60 million pounds of long-term contracts into our book. It's about as much as we want to be doing. We don't want to be doing a whole lot more. This is mostly off-market stuff. It's the type of work we do bilaterally, exclusively with the utilities who've kind of figured it out. They better start contracting. But the other part of the market is the on-market RFPs that you referenced, where utilities come out in a very public fashion, and they pit the producers against each other and try to get very competitive pricing. And normally the interplay has been, for us, a fair amount of off-market discussion with the occasional RFP. But what's interesting this time is we actually might see less on-market RFPs than we normally would, because the leverage of an on-market RFP has kind of gone away. When you're dealing with a utility off-market, and you're pushing for price mechanisms that are levered to future prices, for example, as a producer, our customers were always able to dangle the prospect of an RFP over us and say, oh, well, okay, yeah, you really want a lot of market leverage there. Maybe we should just do an RFP and find out what Kazatomprom is thinking or what Orano is thinking about prices going forward. And that was always a bit of bargaining power for our utilities. But now, with the presence of this Sprott vehicle, I think utilities are rightly weary of putting too much public demand in the market, because that'll go around the investor community really quickly, especially if particular utilities, the bigger ones, get identified as having demand in the market. Bit of a worry that signal might charge the at the market feature for the Sprott vehicle. They'll issue a bunch of trust units, take in proceeds, and then go on one of their demand surges precisely at the time where a utility's trying to price their contract going forward. So we actually may see a continuation of more off-market activity, but that's good news, because in our business, contracting begets contracting, and we're in the very early innings of it. There have been a few RFPs, there's been some off-market stuff, but we are a far way away from even replacement rate contracting, which is where utilities are buying basically what they consume every year. Versus the beyond replacement rate contracting that happens when a true security of supply sentiment sets. So we've seen a $10 increase in the term price, and we're only in the very early innings of this transition.
So I'm curious about the mechanics behind these off-market transactions. And just so I understand, will a utility phone you up and say, hey, Grant, I need 10 million pounds, can you help me out? Is that the discussion?
Well, yeah, I mean, we can sort of describe it that way, but remember, we never stop talking to our utility customers, because there's nobody that we're dealing with who isn't already a customer, and we're already selling the material. And so, since Fukushima hit, we've delivered over 300 million pounds of uranium. This is the business we're in, so we're constantly in contact. And it wasn't that our customers were uninterested in where future supply was coming from. It was the gap between the bid and the ask spread on the price was just too big for us to be willing to lock in volumes, because we don't have a volume strategy. And so as the price starts to move, those conversations get firmer and firmer, and they're really about taking the business we already have and build it going forward, as opposed to kind of starting from scratch off market.
And I'm curious about how the terms have changed, in the past year. Are people looking for longer term contracts? Are they going from 3 years to 5 years to 10 years?
Yeah, it's a great question. So I'd said earlier, spot's not the primary market. And when we go through these term contracting cycles, the tenor of the term business stretches out. So if you think about the price spike in 2010 or the price spike back in 2007, the industry kind of ended up with a term contract that was on average 10 years. So some utilities were taking a much bigger bite out of the market, some were taking a smaller bite, but the average was 10 years. But as we came through the Fukushima situation and the spot was oversupplied, tenors shrunk. Right? Because carry trade can't be as long as a term contract with a primary producer who actually has a productive asset. It's as long as a financial is willing to carry that material. So we saw the tenor shrink. Utilities were taking smaller bites out of the market, 2 years, 3 years, 5 years, so that they could still participate in the competition of the carry trade and not throw their demand far enough out so that they actually had to price productive capacity in there. But now, as we start to emerge into more of a sustained term contracting cycle where utilities are looking out into the middle of the decade and beyond, and they're seeing that demand curve go up in a durable way, and they're seeing the productive capacity today only cover about 70% of the demand that's out there. That's when you start to see the contracting develop at a frequency and a volume, and it stretches the tenors back out. And I'd said in our Q3 conference call, in response to a question, I was asked kind of the tenors in our pipeline of off-market discussions, and I said we've got some utilities that we're talking to right now about material in the next year, 2, 3, but we've got some utilities we're talking to about material to the end of the 2030s. So these are the types of demand signals that really are the leading indicators of a cycle.
Interesting. And you made mention of the price move we saw back in 2010, and that was on the back of the Chinese entering the market and pretty well taking up a lot of the supply, and it drove the price. If I remember correctly, it might have gone from $30 to $70. Does that sound right?
Yes, good memory. Peaked at 74 just before the earthquake and tsunami hit the shores of Japan.
So I guess my question to you is, the Chinese just entered into a couple of contracts with Kazatomprom that was press released. And do you think this is the beginning of a new wave of buying from the Chinese?
Well, I do, but I wouldn't say that I'm prepared to conclude they're going to come in the way they did last time. It was a bold move. It was a big move. They came in the summer of 2010, really for the first time to the term market. The rest of the utility base around the planet was pretty well covered in 2011, 2012, 2013. We were sitting in kind of one of those very complacent windows. Price had come off a long way since 2007's peak, and they bought 150 million pounds in 1 month. You know, a third from us, a third from Kazatomprom, and a third from the French. Big bites out of the market, and effectively they were buying for 2014 to 2024. That's basically what they were doing, a big bite out of the market. And they forced all the other utilities who were well covered for the next several years to actually go through the door at the same time, because the big new entrant was tying up all that material. But I would say that our Chinese customers probably don't want a repeat of that. They probably realized that it was too much at once, and it triggered one of those contracting cycles. And so I think this notion of RFPs, smaller bites out of the market, layering in more frequently, that's probably a behavior that you can expect to see, unless we have, you know, a shock-driven reason to see bigger demand. An energy policy failure where other energy sources within country are not performing like they should be, and a doubling down of the nuclear enterprise, and therefore nervousness about the strategic inventory and the run rate requirements. If that kind of shock hit, you know, then you could see a bigger chunk being taken out of the market, more like 2010. But if it were to be done in a more rational way, I think we can just expect them to be a more frequent buyer. They're going to need the market to meet their needs, and probably take smaller bites out of the market and layer them in over time, like largely the rest of the utilities do.
So that's a great overview of both the spot and the term market. Why don't we move on and talk about Cameco now, and just why don't you provide us with a brief overview of Cameco and its various operations?
Yeah, happy to do that. So I'm glad we started with the market, because that explains why we do what we do. And so Cameco today is a company that has just come through probably the worst bear market in the uranium space on a cost-adjusted basis that we've ever seen. We've come through that with $1.4 billion in the bank, an investment grade rating, leveraged to future prices in an extraordinary way. So we're very, very comfortable with the position we're in. But getting to this position was not painless. It required us to take a lot of leadership in the market. That leadership was the form of an extreme supply discipline. You know, others, we talk about Kazatomprom taking 20% supply discipline, for example. We were at 70%. You know, Cameco alone left 114 million pounds of uranium in the ground. We bought 56 million pounds of uranium. Sprott's at 20 now. We bought 56. We drew down a 20 million pound inventory that we had built up because we were too stubborn to sell material into a weak spot market. And we achieved all of that with a robust balance sheet and now leverage to the upside. So we preserved some of the best assets in the world for future prices and better prices. We feel pretty good about that. We're still in our supply discipline, but happy with what we're seeing in terms of the evolution of a term contracting cycle. So we're sitting here as a tier one producer with tier one assets, plenty of leverage to the upside, plenty of protection if the market stays weak for a bit longer, and really like the position we're in at a time when the world is also saying it's not good enough just to be a producer. You got to be a producer that achieves world-class ESG metrics at the same time. We love that conversation, as you know. ESG, the only thing new about that for us is the moniker. It's been at the very heart of what we do from the beginning. So we just really like the way this is shaping up. Our Canadian supply geared for a market that's worrying about where origins are coming from. It's just, you know, I think really is looking very promising for us.
And one of your key producing mines is Cigar Lake. It produced 5 million pounds last year in 2020. How's it tracking in 2021?
Yeah, thanks for that. Cigar Lake, of course, is been continuing to run. So while we were on supply discipline, it really was the McArthur asset combined with our US and Rabbit Lake assets that were bearing the brunt of that. And we've continued to run Cigar Lake and our asset in Kazakhstan. We've got an extraordinary asset that we own with Kazatomprom, and we're very, very pleased with it. But Cigar Lake running it is part of our strategy. You know, we can't do all of the cleanup ourselves without some tier one costs coming into our structure to help offset the pain of care and maintenance and the pain of buying material more expensive than we can produce it for at McArthur. So Cigar's pretty key to that. But Cigar was not immune to COVID. So we had a shutdown last year, and we also had a shutdown for a period of time this year as we were, you know, awaiting the vaccinations and making sure the industrial protocols were there, not just to keep our workers safe, but to keep their families safe and to keep the community safe. As you know, these are remote operations, and we draw a lot of workforce from the northern communities here in Saskatchewan. And we have just an absolutely inviolable commitment to their health and safety. And these are communities that don't have access to the same level of healthcare that we would have just down the street. So our burden and our responsibility was higher, and we took it very seriously, and that's why we shut Cigar down. When we brought it back up, when all the protocols were in place, very effective restart. It continues to track at annualized rates, which is where we want it to be. But we were never going to catch up with production. We were never going to catch up in year. Didn't intend to. So it's operating very well. It's operating the way we want it to be. And it's a key part of our strategy.
And by having McArthur River and Key Lake offline, how many pounds have you removed from the market?
Yeah, if you think about the whole basket of our production curtailment, that's 114 million pounds of uranium that have stayed in the ground. And so think about it this way. We choose to inventory material in the ground and rather than pull it out of the ground and put it in a shed. And the reason we do that is we think it's just a much more powerful signal. If you don't need it today, then leave it in the ground, because then it's very clear that it's an economic decision to go after it versus a cost of carry or a working capital decision. You know, we discovered as we were producing from McArthur and building up an inventory because we were too stubborn to sell, we were becoming an overhang in the market. You know, we would sit with our customers and we would say, we're looking at your uncovered requirements, you know, and we think you need to start signing contracts. And they'd say, well, we're looking at your inventory and we think you need to start selling material. So we said, okay, we can deal with this problem ourselves. We can curtail. We can run that inventory through our committed sales portfolio, never see those pounds again. And so for us, that discipline has been the inventory is there, it's still in the ground. And here's one way to think about our strategy. When we embarked on MacArthur's shutdown, the uranium price was under $20 per pound. It was actually at its low of $17.75 per pound for a brief period of time, and probably going lower had extreme action not been taken. Today, in the spot market, it's at 47. So on a mark-to-market basis, those pounds we left in the ground, that's a $3 billion value transfer. That seems like a pretty good payback on our strategy in a short period of time.
You mentioned earlier that your balance sheet is in very good shape. You're sitting on $1.4 billion in cash. How are you going to allocate that in the coming year?
Yeah, for us, the decisions around our capital allocation are really about shoring up that run rate business. So I said we're in the early innings of a term contracting recovery, but that also means we're not there yet. We haven't made the decision to restart MacArthur. So while MacArthur is down, while we have to source material outside of producing it in order to meet our committed sales, we've taken the position that we're going to self-manage risk. We're going to be very conservative with our balance sheet, and we're going to send the signal very loud and clear to our owners that they can count on us not coming along with any awkward lurches to the capital markets because we have to say, well, we embarked on a strategy we couldn't afford, or we embarked on a strategy we couldn't manage ourselves. So for us, this has been a key part of managing through this cycle and sticking to this strategy to see the payoff that is starting to emerge as that book of business builds. And as we're in a position to restart MacArthur, we restore our tier one costs. We shed the care and maintenance costs. We get out from under buying material way more expensive than we can produce it for. It restores our financial performance in a fairly dramatic way, as you can imagine. These are tier one assets, and we're eager to get them running at the right time. And at that point, it'll trigger a conversation, the obvious conversation. Are we sitting on a cash position that should be deployed for something else? Do I have a great investment proposition to take to the owners? I'm not sure at the moment. At the moment, we've got a brownfield leverage strategy that can be funded out of cash flow. So it's not clear to me we would need it for that reason. So we go through the exercise of saying, well, what's the best purpose for it then? And if we don't need it, then we stick to the principle that we're not the savings account of our owners, and we're going to give it back. And then it's a matter of figuring out the best way to allocate it back to the owners who deserve it for the patient. So for us, we're not out of the woods yet. We're still on our extreme supply discipline, but we're in a very comfortable position being able to self-manage risk.
Grant, as we wrap up, what can investors in Cameco expect in terms of news flow in the coming months?
Yeah, you know, we're going to continue to talk about the contracts that we're able to secure. So we'll talk about our pipeline. We'll talk about what we're seeing. Obviously, as we start to build back to a situation where we can do what we do best, which is mine, you know, you'll hear that from us. But we recognize that it can be an opaque market. So we'll take opportunities like this one, Jimmy, to just at least share how the world looks through our eyes. Where, you know, not everybody agrees with us tactically on what we do, and we get that. We're in this full cycle. We've seen every single cycle. We've survived every single cycle, both the ups and the downs. But we'll always share what the world looks like through our eyes. So probably hear more from us if you invite us back. We'll take up that invitation, because I think it's important to help people understand how this market actually works, because there's a great investment opportunity that still remains ahead.
Grant, I have one more question before I let you go. I'm going to put you on the spot now. Where's the price of uranium going to be in 5 years?
Yeah, well, you know, it's a great question that I won't answer and I can't answer, but maybe from a framework point of view, what we know is that in order for productive capacity to match demand, we need prices that incent production, and that incent production from the tier one assets that aren't producing at full capacity or are at zero. So we need that price move. Not quite there yet, but we also need a price move that is going to incent tier two assets that are licensed, permitted, but not running to come back to the market. We also need a price that's going to incent the beginnings of investment in new production. And I don't quarrel with the folks who put out the big cost studies that say that price probably starts with a 6 or probably starts with a 7. That's where it needs to be to truly incent the production. And then, of course, it's up to the supply side to do it right. It's up to the commercial players. You can only have limited expectations on the state-owned enterprises, but the commercial side of the business has to do it right. They have to have a great resource that they align with the opportunity in the market. Because if they have a great resource that's not aligned with the opportunity in the market, we're just going to go through one of these cycles again. We're going to end up investing in a bunch of productive capacity that's homeless, and it's going to end up in the spot market. We're going to resume the carry trade, and then we're going to have to fix the market all over again. So hopefully, lessons learned. Lessons learned, take great assets, time them with the market. Prices probably need to be starting with a 6 or 7 to see that kind of sustained investment that's going to meet what is truly becoming a robust demand profile for this exciting industry.
Well, great. That was a great discussion, and thank you for sharing your thoughts on both the spot market and the term market, and also Cameco's various operations. And to all of our viewers, if you have any further questions for Grant and his team, by all means, send us an email to info@bloorstreetcapital.com and we'll get you an answer. Grant, once again, thank you.
Yeah, thank you, Jimmy. It's our pleasure.
Hi, Guy, and thank you for joining us today. How are things in Sydney?
Thanks for having me. It's great to be on. Sydney's going well. We're free here finally, and the summer's just about to start to kick in, so can't complain.
And is downtown Sydney busy? Are people back to work?
I wouldn't say back to work, but they're certainly starting to get back to the pubs and the restaurants here. There's some offices are open, and but others, there's a lot more bodies around the city, so it's good to see.
Guy, I'm looking forward to this discussion on uranium and also uranium equities. But before we do that, why don't we just start with a brief overview of Tribeca Investment Partners? Where are you based? How many employees are there? And what's your AUM?
Sure. So Tribeca Investment Partners, we're a boutique fund manager based out of Sydney, Australia. We also have an office in Singapore as well. We've got just over 30 staff. We run just over sort of $3 to $3.5 billion. As well as our asset management business, we also have a wealth advisory business and a corporate advisory business out of Singapore as well.
And once again, your focus is strictly on resources?
Yeah, so I work as part of the global natural resources business, which is one of the prongs in our asset management business. I've been here just over 4 years after a career of commodity physical trading in various parts of the world. And as part of that global natural resources business, we then rolled out the Nuclear Energy Opportunities Fund within that as well.
Guy, that's a great overview of Tribeca. Now let's move on. I want to focus specifically on uranium, and you do have a Nuclear Energy Opportunities Fund. Can you tell us a little bit about that fund? How much money, or what's your AUM of the fund, and exactly how many stocks you hold in the fund?
Yeah, so we rolled the Nuclear Energy Opportunities Fund out of from the global natural resources business. So on our global natural resources business, we come very top down. What I do, I get a batting order looking at fundamentals and various other signals for the commodities. when we looked at uranium after I'd covered sort of metals and the energy complex, as well as the sort of battery metal space, it flagged as extremely interesting. However, when, as part of our global natural resources business, trying to get a significant enough exposure in the uranium mining sector 4 years ago meant that we very quickly became substantial shareholders in the handful of companies in which we invested. And that caused us to roll out the nuclear strategy because, I mean, even now, the whole investable universe of uranium miners fits inside the market capitalization of Freeport, for example. So it's very small. So we did roll out that strategy, as I said, 4 years ago. We kept it small on purpose so that we were able to get exposure. I mean, it's a concentrated portfolio, but then the interesting thing is the uranium sector itself is a concentrated portfolio because, you know, I think when we looked at it, there was about 30 or 40 investable opportunities. But the reassuring thing for that was when you look back at history and, you know, the bull market of 2007 to 12, there was about 500 listed opportunities. So, you know, in our mind, it was the right thing to break out into a smaller strategy to be able to be in early enough in some of these opportunities, because as we've seen, when it moves very quickly.
And I'm sorry, how many names do you have in the fund right now?
Right now, I think I have about 18 to 20 names, and that's globally. So it's across every sort of jurisdiction.
And given the move in uranium this year, how are the flows being into the fund? Are you getting a lot of money from investors?
Yes, I mean, we run a quarterly application window for that fund, and obviously in the last few quarters, I think we've done the 7th quarter in a row of positive performance that sort of started April 2020. And so there has been, I mean, it is interesting because it's so small that a lot of other institutions can't get in, but we're seeing a lot of the family offices, high net worth, are identifying this as an opportunity and knocking on the door. But you know, that's also in line with the flows we're seeing more broadly in a global natural resources strategy in the last 12 months. That theme has become more popular again, although in our view still underinvested. So we're seeing investor interest across the whole global natural resources space.
And how has your performance been in relation to the Horizons Global Uranium ETF?
Yeah, it's been pretty good. So I think the last Aussie fiscal year, which is July 1 to June 30, we returned 345% post fees. And that compares to, I mean, it beat every ETF. It beat a large basket. I think we have there to compare. At one stage, Paladin had pipped us at the post, but we managed to get back from that. And I think the difference there is this sector requires you to be active. It requires you to be nimble. You know, whilst an ETF exposure is a good broad exposure that doesn't require you to do a huge amount of work, I think our return shows that when you are prepared to invest the time and the relationships into this sector, you can really properly outperform those ETFs.
And Guy, the spot market has changed significantly in the past year with the influx of financial players. Yellowcake recently purchased an additional 3 million pounds on the back of an equity deal. They now hold 19 million pounds of uranium. Sprott will be an ongoing buyer just on the back of their ATM mechanism. They now have 35 million pounds, give or take. And Kazatomprom recently announced that they're also going to start a fund with the intention of buying and holding uranium. With these financial players, cleaning up a lot of the excess supply that we had in the spot market, do you think the spot market's going to become a lot more efficient? And do you think the utilities or the buyers, the long-term buyers of uranium, are paying attention to what's happening in the spot market?
Yeah, look, I mean, the advent of Sprott especially has meant that there's now a price in the market that's tradable every day. And, you know, I think equity investors often assume, sometimes incorrectly, that physical commodity markets are efficient. And I can tell you from a career of over 20 years trading in those markets, they're not efficient. And uranium especially is probably one of the worst examples of an efficient spot market. So, you know, the Sprott vehicle is now forcing price discovery, and whilst there has been a lot of volatility around that price in the last 2 months since they've been in existence, you can now hand on heart look at a broker print and say that's a fair reflection of where pounds would have transacted. The second part of the question about utilities, yes, utilities have to be paying attention to this, because you've seen a 70% increase in the spot price from low to high, and you know, about a 37% increase in the spot price since inception. Obviously, we blew up to $51 and we're unable to hold that. Sitting here around $42, $43 is still enough to get their attention. And whilst utilities are not active on a daily basis in the spot market, it certainly has been a market that they have tapped in the last sort of 8 to 10 years with respect to topping up pounds via carry transactions. That in our view, you know, and not just our view, others are forming the same view, that mechanism is becoming much harder because these physical vehicles are soaking up available pounds that then may have been used for a carry trade in the past.
And having said all that, uranium's had a big move on the year. It's currently up 40+%. Many equities are up 100 to 200%. Are you still bullish on uranium in the short term and also on equities in the short term?
Look, I mean, the short term is going to be swings and roundabouts. We've seen the you know, advent of, I think the difference this time in this bull market, or the beginnings of this bull market, is we've got much more available information and the ability for people to access markets much more quickly via trading platforms and now social media pushing themes. So you are going to get a lot of volatility as that fast money rushes in and out. I think the moves that we saw in September, for example, around some social media campaigning, proved to everybody how small that door is to enter into this investment thesis. So when that opportunity came as that fast money exited, it did give up other longer term players like ourselves and other players who are maybe newer to the trade an ability to tap that liquidity and top up on positions that we're looking to play out over the next 6-9 months or 2 or 3 years even. So yes, short term, absolutely. I mean, you saw just recently with the news from China overnight that when you get catalysts, it does move quickly, and you can't really afford to sit back and try to pick entry levels if you're longer term bullish.
Guy, I want to move on now and discuss pricing, and more specifically long-term pricing, and try to get a sense where you think it's going. The demand side imbalances appear to be massive. China recently said they're planning on building 150 new reactors over the next 15 years, which is more than the rest of the world has constructed in the last 35 years. Also recently, the European Union is considering classifying nuclear energy as green under the taxonomy regulation, and with a decision coming possibly in the new year. And then there was also an article recently on Bloomberg. They were talking about ESG funds, and I think worldwide they're sitting around 35 trillion, and that number is expected to grow to over 50 trillion by 2025. And you just look at all these demand side imbalances and what can really drive the price higher. So I guess my question to you is, why isn't uranium at $100 already, or 150?
It's a very good question, and I think that's the point. You look now as to the news flow around uranium, around nuclear, around green, around ESG, decarbonisation, and it's everywhere now. COP26, Europe, it is everywhere, and that's one of our themes. With our global network, 2 of our themes around in our global natural resources business are decarbonisation, electrification. And the reality is you can't reach electrification without nuclear power if you also want to decarbonise. if you want to go and build a whole bunch of battery electric vehicles and say we're electrifying, great, but you want to decarbonize at the same time, you're plugging a battery electric vehicle into a power plant and it's coal-fired power. And that's our big theme, and I think that's becoming part of just normal, dialogue. So why is it not higher? And the answer to that comes back to it's a small market, and there's one set of buyers, which are utilities. It's not like steel or iron ore, where you've got thousands, if not tens of thousands, of steel mills competing for cargoes of iron ore. Or other commodities where it's a similar thing. It's a small group of slow-moving, long-term buyers, and they're not, utilities, with the exception of probably France, certainly in the United States, the utilities there are not just nuclear utilities. Nuclear is maybe 20% of what they do. So you look at those sort of the Duke, the Exelons, all those sort of guys. They're running coal, they're running gas. They've probably got some, oil. They've maybe got some hydro if they're lucky. They're trying to build out some wind and solar, and they've got nuclear. And they're looking at the moment, we're in one of the biggest energy crises that we've had probably since the 1970s. And these guys are sitting there looking at coal prices through the roof, at gas prices through the roof, that is hand to mouth. Like a coal-fired plant is maybe holding, what, 20 days of inventory, gas even less because it's connected to a pipeline. And they're sitting there saying, hang on, at a board level, the cost of our input, which for gas and coal is 85 to 90% of their OPEX, has just tripled. And you want me to go and waste board time at the moment talking about securing long-term supply of uranium that is 8% of our fuel cost? We don't need to look at it yet. And so I think that is what people need to understand. Whilst we have fast money people looking at previous cycles saying, oh, this stock did 10,000% and this, that, and the other, the actual buyer of the commodity is not fast moving. However, when they come in, they're going to come into a very different market than the last time they were in a contracting cycle. They're going to come into a market where the two physical vehicles at the moment have sequestered 44% of 2020 mine supply. And they're going to come into a market where there's no big projects waiting in the wings like they saw in 2007 to 2010. In fact, back then, I think there was 30 projects that were slated to come to market. 7 did. Now we're sitting here in a process where the two biggest producers of curtailed production, there's a handful of care and maintenance assets, but there's the next pounds need to have a mine developed, need to have a plant built, need to have permission and a capex raised. So utilities are going to come back to a very, very different environment when they get there. And I think that's when you see a long-term sustainable price that is much more constructive than short-term moves in the spot price.
And in terms of value, equities and valuations, I mean, where do you think the prices would go if the European Union went ahead and made nuclear green energy? Like, you can just imagine all these European ESG funds piling into the space. Like, these stocks would go ballistic.
That's exactly right. The French government is looking to approve the construction of 6 massive reactors, 1.6 gigawatts reactors. The European taxonomy, recognizing nuclear as green, gives them access to cheaper funding. It also opens the door to ESG funds to be able to say, I can now invest in things around civilian nuclear, and that's something that ESG funds, they'll say, I'm anti-nuclear, but they're talking about the weapon side of it, not civilian nuclear. So it allows funding to come into the space. It allows, because there's a directive from the EU, it allows a fund manager to make an easy decision and say, I'm investing now because that taxonomy allows me to say I can. So, and yeah, I mean, I think 1% of ESG flows coming into this sector right now is just extraordinary amount of money that will just be certainly not resulting in any of these stocks being lower, that's for sure.
Guys, we wrap up. I want to change the subject a little bit. One of the great things about mining and also the investment industry is that it can take you all over the world. And with your job, you've lived in London, Singapore, and now Sydney. And I'm just curious, those are all great cities, but did you have a preference for one of them?
Well, I'm a Sydney boy born and bred, so I'm always going to have a preference for Sydney. I certainly enjoyed my time in London and sweated through 6 years in Singapore as well. But yeah, no, Sydney certainly. And I mean, the interesting thing when the world wakes up from the COVID scenario and travel becomes, there's going to be some exotic places I can visit. I can tell you that much with the uranium hat on.
Guy, I want to thank you for introducing us to Tribeca Investment Partners and how you and your team value uranium equities. Thank you.
Thanks very much for your time. Appreciate it.
Well, that brings us to the end of our uranium conference, and I hope you found it informative. Don't forget to subscribe to our channel, Bloor Street Capital, and also hit that notification button to be kept up to date on future events. We have some amazing conferences coming up, and the best thing about this format is that it's free and you don't have to leave your home to attend the event. Once again, thank you for your support.